going to be a real bumpy road on this whole tariff process.
At this point, rubber needs to meet the road. We need to actually see some numbers here.
This is a process. It's going to take time.
This is a really big shock that's coming at the economy.
The damage is already being done. The rest of the world now sees the U.S. not necessarily as a very credible trading partner.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Heading into the weekend, preparing to negotiate.
Mr. President, if the talks go well this weekend between Secretary Bess and Ambassador Greer with their Chinese counterparts, not preemptively, but if the talks go well, would you then consider lowering the tariff rate on China?
Well, it could be. I mean, we're going to see. Right now, you can't get any higher. It's at 145, so we know it's coming down. It's going to be very good for both countries. I would like to see China opened. I do think they have far more to gain than we do in a sense, but we're going to have I think we're going to have a very good weekend.
Setting up for talks about talks with China. Delegations from both nations heading to Switzerland. The team here at Bloomberg reporting the US side has set a target of reducing tariffs below 60%. Investors are hoping there's a whole lot more to come.
Maybe what we've learned over the past week is that Trump is perhaps a little bit concerned about the damage that he's wrought with some of his discussions about taking hard talk, saying you better go out and buy stock now. Stocks sort of gussied up and said, wow, we feel recognized. There is this question of how much of the talks actually gotten done. How much can they get done? And how much has this president changed his tone when it comes to conciliatory talk?
Some deals are easier to strike than others, and I think the UK deal, the administration themselves suggesting the UK deal will be easier to strike than others. This from Europe just in. The European Commission President Ursula von der Leyen saying, I want a trade package ready if I'm going to visit Washington, D.C.
Well, the talks are ongoing when it comes to the European Union and this administration. I actually caught up very quickly with Jameson Greer yesterday walking outside the White House. And I said, is Europe very low on the totem pole when it comes to this list of deals? And he said, we are willing and ready to negotiate with anyone that comes to the table with also plans ready to negotiate. So potentially this is von der Leyen and an olive branch saying, I have something, potentially if I come to Washington, D.C., I want to sign it, just like the United Kingdom did.
You're already seeing this story in the data, the trade data out of China. Exports to the U.S. down 21% from a year earlier in April. Where were they up? Across Asia and across Europe. Exports to the EU up 8% over the same period. This is the discussion we've been happening. Central banks abroad are facing potentially a disinflationary shock, and that's reinforced by the data we saw overnight.
Which is the reason why you're starting to see negative yields make a comeback in places like Switzerland, because the appearance is there is this ability for central banks in Europe to cut because of these disinflationary impulses that maybe are unique relative to the United States. Look, there is a real question about how these negotiations can go when Europe agrees that this is a problem. I will say Europe, most of Europe agrees that this is a problem to get cheap exports from China, but they are not negotiating necessarily as a bloc, and that's what needs to happen first.
When you see exports of Chinese goods on other economies going up and lower in the United States, it also proves that other economies are going to want to see a trade deal between Washington and Beijing because they don't want their economies to be dumping grounds. And I spoke to their Treasury Secretary about that 3 weeks ago, and he talked about how the Chinese economy is not going to stop manufacturing. It's like that movie Fantasia in Disney with a bucket and the broom, and it just keeps going and going. They will dump somewhere, and we see in this data they actually are.
I never enjoyed that production at all as a kid. Anyway, equity futures on the S&P. I don't know how much you're enjoying this. Equity futures on the S&P positive by 0.2%. Coming up this hour, Max Kettner of HSBC as the president says buy stocks. Ed Mills of Raymond James previewing US-China trade talks. And Tom Tzitzouris of Strategas as Trump keeps the pressure on Fed Chair Jay Powell. We begin this hour with stocks steady ahead of US-China trade talks. Max Kettner of HSBC with this to say, remaining cautious against the backdrop of volatile policy conditions and high uncertainty. It is difficult to envision a scenario in which this resilience of risky assets persists. Max joins us now for more. Max, welcome to the programme, sir. Looking forward to the weekend. Can these talks and the hopes of deals continue to persist this equity market? Has been a story, a question we've covered for the last several days, Max. What do you say back?
Yeah, good morning. Look, I think we have this dilemma right now between, on the one hand, the hopes for trade talks or successful trade talks On also, of course, on the other hand, also positioning and sentiment data, particularly from systematic strategies, think things like volatility target strategies, think things like risk parity strategies or CTAs, trend following strategies. At least on our measures, there the positioning, the exposure is still really, really low. So yeah, any kind of whiff of positive news around trade talks that could propel us a bit higher. But of course, on the other hand, that's the dilemma that we're facing, that pretty much all the leading indicators that we are tracking are really pointing south. And that is not south in terms of, oh yeah, it's a little bit worse, but we're talking COVID levels or we're talking financial crisis levels. And the difference to, I would say, 2-3 months ago is 2-3 months ago, you could have argued that's just consumer sentiment, ignore it, it's no longer working, because it really is dominated by this political division between the responses from Democrats and Republican-leaning consumers. Whereas now it is, of course, it's capex intentions, it's labor market conditions, it's CEO confidence, it's regional Fed service, it's the new order outlooks, right? It's things like shipment expectations. So it's across the board where we are seeing the weakness. And that is what I am scared about. I think not only just the next sort of 2-3 quarters, but specifically the next month or two, that already now we're going to start to see some disappointments on some of the hard data, which I think is enough because, let's face it, the narrative is still very, very broad-based. This is not a recession. This is just a slowdown. It's just the soft data. The hard data is keeping up. And therefore, I think a couple of hard data points disappointing is already enough to send us a bit lower.
Max, you know what the response would be? Look at claims are okay. Look at payrolls on Friday, payrolls are okay. What do you say back to people when they raise those data points? Do you say, well, wait another month, wait another 2 months? What's the calendar look like for you?
I mean, that would be exactly my response. Wait another month or wait another 2 months. Look, I think on jobless claims, there is actually a basis for saying in the next 2 months, we could see a bit of a seasonal pickup into summer because we've had that in 2023 as well and in 2024. Remember this time last year, we've had sort of the peak in yields. We've had the peak in 10-year yields, and then we had negative surprises, and we had in particular jobless claims picking up sort of 40, 50,000. Nothing dramatic, but we had, of course, things like, you know, the auto plant shutdowns in Michigan. So we have things like the hurricane season, school holidays. All of that could propel us a bit higher. Again, nothing dramatic, but perhaps 40, 50,000 higher over the next really specifically 2 months. We are seeing that seasonally normally beginning at the end of May until sort of the third week of July, most likely, right? So it's really a case of the next 2 months. And let's face it, we're also probably going to see in the next 2 months the first effects from Doge, because of course, a lot of those 3-month pay packages are running out. So we could be seeing perhaps a couple of thousand or so in those jobless claims. Again, nothing dramatic, but something that perhaps puts us really quite close to the 300,000 mark, at least temporarily over the next 2 months. It might easily be a head fake when we look then into the second half, but I do think if that really happens in the next month or 2 months, that is enough to, you know, get you guys, for example, going in Bloomberg and saying, oh, are these the cracks in the labor market? I think then we'd be all waking up and on the terminal we'd be saying, oh, you know what, these are the first cracks that we are seeing. And I think that already would be the first sort of hard data points that would be pointing to the downside.
I love your impression of us, Max. Thank you. I am curious. You did say that you do see a sort of surprising amount of resilience in risk assets so far. What kind of downside are you expecting and would get you, frankly, interested in U.S. risk assets?
Yeah, look, when we look at cyclicals over defensive, so the ratio of cyclicals defensives globally in equities, that is around 9 percentage points away from our top-down estimates, top-down sort of revision estimates and fundamental indicators that we've got. So I do think it's particularly the cyclicals, right? Again, 9 percentage points. It's particularly the cyclicals that have rallied really a little bit too much and are pricing in a bit too much hope and a bit too much hopes for this is just a one-off. And if anything, it's just the soft and the survey data. And if anything, it's just a growth scare like last year and summer as well. Let's face it, particularly long-only investors, at least on our measures, have also not moved particularly strongly. Yes, they've sort of cut their overweight in equities, but they're still slightly overweight. They're still nowhere near even neutral. And in particular, they're nowhere near that underweight stance that they were having on consensus, particularly the real money investors that they were having during 2022, during that bear market. We're miles away from that. So that is, I think, where we are waiting for the first a couple of hard data points to disappoint. And that, I think, would then get us going in terms of a bit more selling coming from discretionary and particularly long-only investors.
It seems like there are two different ideas embedded in your call, Max. There's the policy uncertainty, which remains a question, and whether we can get some more certainty, not only with the UK-US deal, but over the weekend. And then there's the damage that's already been wrought. How much is your concern the former and ongoing policy uncertainty, despite some of the more constructive talk we've heard? And how much is it the latter, the idea that you can't put the toothpaste back in the tube and that the damage is already a de facto reality that's going to be in the data in a couple months' time?
Yeah, I think it's more the uncertainty, really, because so let's hypothetically go through a scenario where we wake up tomorrow and the administration decides, look, tariffs were not particularly the smartest idea. Let's scratch it entirely and let's move on to only deregulation, tax cuts. Let's perhaps cut the SLR for banks, for example, so only the supportive stuff. Then I think we could comfortably say any kind of disappointments in the data going forward in the next month, 2-3 months, any kind of disappointments there, the market is comfortably going to look through that because that's based on the old policy setup. Now we've got the new one. The possibility of that, or the probability of that, is maybe it's a slight, ever so minusculely slight tail risk, but it's extremely low. So to me, it's really the continued uncertainty, even though, we might have some further deals. I think John was saying it in the very beginning. The US-UK trade deal, of course, was pretty much the lowest of the low-hanging fruit. So therefore, I'm not sure if I'm reading too much, or if I'm getting too much comfort from that. The big ones are European Union and China. And if we see further uncertainty prolonging over the next 2-3 months into summer recess, into the summer holidays, then suddenly we're talking September. And then, capex intentions continue to be really low, continue to be delayed. I think that is then really the much more crucial one, rather than just looking at the hard data. The hard data is crucial right now because the narrative of it's just the soft and survey data, that narrative is so entrenched. So that's why specifically right now the hard data is really important. But overall, I think it's really that prolonged, extended time of uncertainty that really is a drag overall on activity.
But Max, yesterday the president was saying that he's expecting substantive talks with China and that the rate at 145% is going to come down. So what happens Sunday evening if they come out and say we're cutting the tariff rate to 50% on China?
Yeah, I do think, however, that is pretty much market chatter. I think I'm not sure if I would call it overall consensus, but I think that is something that's been sort of touted quite strongly already. So I'm not sure whether we wake up on Monday and we're like, oh my God, this is so surprising. We'll need to send US equities up another 2%. I think that's pretty much expected at the moment. So from that, again, I'm not taking too much comfort.
Hey Max, if you had a market birthday wish for this weekend, what would it be?
It's probably one where I would say perhaps, at least for our view, perhaps less positive news, and people really realizing that uncertainty is not going to get away. I think on the weekend, of course, the problem is it's probably the wrong period for me to wish anything for because, of course, we're not going to get any hard data. It's really perhaps next week retails, next week's CPI, for example. Perhaps if we get CPI, particularly goods prices, already higher than expected, that already would tell people, oh, you know what, we're already starting to see the effects on tariffs now. But for that, Saturday, Sunday, luckily, is off, and we're going to wait until next week.
I'm just honoured to share this birthday with you, Max. Happy birthday, sir. It's good to see you.
Thank you.
Thank you. Max Kettner of HSBC. Equity futures near session highs here, up 0.25% on the S&P, with an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahara Arnott. Hey, Yahara.
Hi, John. President Trump wants to raise the tax rates on some of America's richest people to offset cuts in his economic package. Sources telling Bloomberg Trump wants a new 39.6% tax bracket for people making at least $2.5 million or couples making $5 million. President Trump is calling for a 30-day ceasefire between Russia and Ukraine and threatened additional sanctions if conditions were not met. Trump's comments contradict Vice President J.D. Vance, who said the U.S. has tried to move beyond the obsession with a 30-day ceasefire and focus on a long-term settlement. And Cardinal Robert Francis Prevost has been elected the new leader of the Roman Catholic Church. The 69-year-old is the first pope born in the United States. He is also a citizen of Peru, where he spent much of his life as a missionary and archbishop. He chose the papal name Leo XIV, and he's currently celebrating his first Mass as pontiff. That's your Bloomberg Brief. John?
What a special time to be in Rome. Yahara, thank you. More from Yahira later on this hour. Up next on the program, the US and China coming to the table.
Mr. President, if the talks go well this weekend between Secretary Bessent and Ambassador Greer with their Chinese counterparts, not preemptively, but if the talks go well, would you then consider lowering the tariff rate on China?
Right now, you can't get any higher. It's at 145, so we know it's coming down. But we're going to have I think we're going to have a very good weekend.
This week never ends. US and China trade talks this weekend in Switzerland. A preview with Ed Mills of Raymond James up next. Live from New York City this morning. Good morning. Don't miss this. Later on this morning, 8 a.m. Eastern Time, a few hours away, Dr. Navarro, the senior trade advisor to the President of the United States, a conversation on trade heading into the weekend, looking for talks between the US and China. Equities right now in the S&P 500 firmer by 0.25% following a two-day winning streak. We add just a little bit more weight to the index, the S&P at 0.26%. Under surveillance this morning, the US and China coming to the table.
Mr. President, if the talks go well this weekend between Secretary Bessent and Ambassador Greer with their Chinese counterparts, not preemptively, but if the talks go well, would you then consider lowering the tariff rate on China?
Right now, you can't get any higher. It's at 145, so we know it's coming down. It's going to be very good for both countries. I would like to see China opened. I do think they have far more to gain than we do in a sense, but I think we're going to have a very good weekend.
Will you speak to Xi after the weekend talks?
I might, yeah, sure.
Here's the latest this morning. The first trade talks between US and Chinese officials beginning tomorrow in Geneva. Sources telling us here at Bloomberg the US is targeting a reduction of the tariff rate below 60% as a first step. Joining us now is Bloomberg's Tyler Kendall for more. Hey, Tyler.
Yeah, hey, John, good morning. Well, if the talks go well, Bloomberg News is reporting that U.S. officials feel that China may be willing to match that tariff rate below 60% and that it could be implemented as soon as next week. But people familiar caution us that things are far from certain, not to mention that Bloomberg Economics says that they do not expect an immediate agreement or a permanent de-escalation after these talks, but that if President Trump wants to get ahead of fears when it comes to empty shelves, tariff rates do need to come down significantly and fast. Now, the White House maintains that China really needs to be the one to de-escalate first here, and that could look like a range of things, including increasing purchase orders, also maybe tightening controls when it comes to fentanyl flows, but then importantly, loosening curbs on critical and rare earth minerals. Our reporting indicates the latter, that's pretty high on the U.S.'s priority list. Now, of course, the other side of this is that China is holding firm that they would like the U.S. to remove tariffs on a unilateral basis. They say that the U.S. put the tariffs on first, so they should take them off first. But it's something that this White House has publicly ruled out. At the same time, though, it's uncertain what the U.S. will commit to and what the U.S. is willing to accept. And officials tell us that's all by design. Going into this weekend, they are focused on strategic uncertainty. But, John, President Trump made it pretty clear to Annmarie in the Oval Office yesterday he does think that these talks could be constructive.
Tyler Kendall down in Washington. Tyler, thank you. I think they've all been pretty clear in the White House. They all seem pretty aligned on bringing tariffs down from around 150%, somewhere closer to 60%. What is achievable beyond that? Joining us now is Ed Mills of Raymond James. Ed, welcome to the program, sir. What are you telling clients about that? What's reasonable? What's achievable?
Yeah, so I think that the key things here are exactly what you reported. Getting those rare earth mineral restrictions off. That's going to be a key ask of the U.S. government, because when we look at those rare earth minerals that China is restricting, we have about a 6 to 9 month supply of that. After that, a lot of industrial capacity, John, in this country goes away. Something that is under the radar, though, that I think is really important to China and really important to retailers here in the United States is there is right now a penalty on Chinese ships. Any of their tonnage has a massive penalty that's going to prevent a lot of ships that are carrying goods from other countries from entering U.S. ports. So that's something that this Trump administration can take away, short of completely taking off tariffs. That would probably do the biggest thing to get more ships coming into U.S. ports and more goods coming into our economy, John.
Ed, when it comes to the potential rate that the U.S. administration can set, a new rate when it comes to China, what's your base case?
Yeah, Annmarie, first of all, great questions and really getting to the point here in terms of getting understanding of what Trump is willing to do. I have heard that the rate going forward could be in that 50 to 60% range for national security goods, potentially lower for non-national security goods in that 30 to 40%. That's what the China committee recommended last year. But it is pretty remarkable that we could have a market positive event where the tariff rate on China is only in the 50 to 60% range. But that's kind of how Trump does things. He really moves the goalposts to 145%. So anything less than that gets celebrated by this market. The one thing that you could see things potentially lower is on those sectoral tariffs. Are there things that are really critical for the United States to get in the near term? You saw that as a key component of the UK deal. And so is that a format going forward? Howard Lutnick was on your ear last night saying that is probably the one way in which you can get lower tariffs on goods outside the baseline for your country.
Any meetings we see between the Chinese and U.S. representatives usually end up being just long lists of grievances. What are the Chinese coming to the table with that potentially a concession that then Trump could end up lowering the rate to 50 or 60%?
Yeah, so I think President Trump cares a ton about fentanyl, and I don't think you can ever underestimate that. I think it gets pushed aside, but that's really what led these conversations to begin with. Now, there is the 20% fentanyl tariffs, and I don't think that those necessarily come off. But if China comes and says, we are going to be serious about the crackdown and making sure we know where the base materials are that go into fentanyl, and if we're restricting that, that would be something that they absolutely would get a positive reaction from this delegation. I think when I look at the delegation, Annmarie, one of the good things here is that it is led by the Treasury Secretary Bessent. You do have U.S. Trade Representative Jamieson Greer going, but you do not have Peter Navarro going. So you can at least have a constructive dialogue versus a complete airing of grievances. So in many ways, what China is bringing to the table is the fact that they're willing to show up at the table. Anything from there, I think, is going to be very positive.
We have Peter Navarro coming on shortly, and we can ask him about that. I am curious what we learned from the UK-US negotiations that can be potentially applicable to what may transpire over the weekend between the U.S. and China, or is this really apples and oranges at this point in terms of the nature of negotiations?
So, Lisa, I think that the UK deal is probably more applicable to other countries. Can we get similar kind of concepts of a plan, if you will, with Japan, South Korea, Australia? India kind of seem to be at the front of the list. What I get asked a lot at Raymond James is, when are we going to get something with Vietnam? Because that's so critical for a lot of consumer goods that come into this country. I think that might be a tier 2. And so as it relates to China, just starting these conversations is going to be the number one priority. I think it's going to be the longest negotiation that's out there. I think what we learned from the UK deal, Lisa, is the fact that we get some kind of details, but a lot of it is to be determined later. That is one thing that gives me a little bit of pause in this market, is that if that is only going to signal that the uncertainty is clearly going to be prolonged, that's a bit of an overhang. But what a lot of folks tell me is, as long as we are past peak tariff, that could be okay. But this is going to be a roller coaster, because this is how Donald Trump negotiates.
Just quickly, what's long to you? Because last time around it was 18 months. What's long?
I think it's probably going into kind of 2027, 2028. How much of this can truly be wrapped up within the administration? Trump went all the way to March of 2020 before he got one trade deal with China. It took 2 years with the USMCA. Now we're trying to do trade deals with the entire world. I think it would be pretty impressive if you can wrap up a lot of that in a 4-year term.
Ed Mills of Raymond James. Ed, thank you, sir. Appreciate it. I'm not sure how thankful the audience are right now, thinking this could drag on to 2027.
Yeah, and what he was getting there, Ed was talking about how the market seems really hopeful that you can tie this up. The market is only down 3.7% since April 2nd. It has surged 14% since April 9th, and the prolonging of some of these tariffs.
Rallied pretty hard off the lows. Equities this morning near the highs of the session, up by 0.25%. Up next on the programme, Tom Fitzgerald of TD Cowen, as the White House looks to overhaul air traffic control. It is going to be a long weekend of trade talks between the US and China, and this equity market is moving higher going into it. 2 days of gains and looking to make it day 3. Equity futures on the S&P higher by 0.25%. On the Nasdaq up by 0.4, with 3 hours until the opening bell. With your morning movers this morning is Danny Berger. Hey, Danny.
Hey, John. We're almost through the busiest week for this earnings season this quarter, and we heard from Pinterest yesterday. Surging. There'd been a real fear going into this quarter that there would be something of a digital ad spending slowdown. That is not what we got. Not only did Pinterest beat in their earnings for the first quarter, but the current quarter, their guide for it was higher than expectations. They touted their AI advancements for why that's the case, but we also heard similar things from Meta, from Amazon, from Reddit. All the digital advertising actually looking healthy. Also healthy were Lyft earnings. And it came just a day after Uber disappointed. Not a disappointment for Lyft. Their gross bookings were higher than expected. They said that they had more active users on their platform. So those shares surging 8%, also getting a boost from an expanded buyback program, something activists at Lyft had been pushing for. To the downside this morning, Expedia after their earnings. The story here is one we've heard from other travel companies, that travel in the U.S. demand has been slowing down. Also inbound travel from internationally. They said that for 2025, they now think that the most optimistic scenario is that they'll grow 4%. That was the low end of their estimate prior. Again, we've heard this before, and they said that Canadian visitors coming to the U.S., that has shrunk by a third. So those shares down 9.8%, John.
Danny, thank you. I've been using Expedia as travel Google for the last several years and then never booked direct. Doesn't everyone do the same thing?
You're not supposed to say that,
Isn't
but
that
yes.
what everyone does?
It's true. You want to get a gauge of it, and then you figure out what you go to, and then you find out you don't have to get that much higher prices at the actual location, and then you don't have all the strings attached. It is true, but just don't tell anyone.
And then if you want the customer service, it's always beneficial to be
direct. Yes, it's true. Maybe that's why Canadians
and you can go
aren't
direct
going
and tell them the price you saw on Expedia.
And then they fix it. Okay, all right. It's not just me. On our radar this morning, the Trump administration considering lowering tariffs significantly during talks with China this weekend. Sources telling us here at Bloomberg, the US is targeting a reduction of the tariff rate to below 60%. The stars are aligning for a move lower in tariffs.
Definitely. And the president said yesterday that you can't go higher. You can't go higher than 145%. If talks go well, then we could see a lower tariff rate. And sources telling Bloomberg that the administration is actually targeting that, maybe 50, 60%. Ed Mills was just talking about maybe it's going to be 50, 60% for national security concerned goods, and maybe even a lower rate for some of the more goods that are textiles. What's also interesting is the U.S. wants magnets. They want the rare earths to make magnets. That's going to be another ask. What does China come to the table with? Do they actually come to some sort of plan to stem the flow of the ingredients to fentanyl? If they do, then I think you can have a deal potentially, or concepts of a deal, by the end of the weekend.
Just to expand on that, what does China want? What do they want out of these deals? We haven't really seen the contours of what the asks are from the Chinese side or the potential desire to get some sort of deal done, because right now this is playing very much to the favor of Xi Jinping in domestic media, where he can say all those problems for the past decade in China's economy, that's Donald Trump's fault. So it's unclear what the incentive is right now for China to come to some sort of a quick de-escalation, especially with exports elsewhere around the world surging.
I can pick up on two things that they'd like. One, they'd like the restrictions lifted on US tech. Two, I think they're very concerned about what happens in places like Vietnam at a time when the United States is pushing for Vietnam to become a closer trade partner to the United States. And I think you saw that in the first move from President Xi Jinping to go up around Asia and just make sure those ties were close with the Chinese and make sure the Chinese don't fall into US hands alongside some of their allies.
The problem with both of those asks, those are red lines. And those are essentially the reasons why the U.S. initially had some bipartisan effort to really go up against China. It is the issue of the decoupling of the tech universes between China and the U.S. And it is this question of where exports are coming from and where they are going through in terms of the connector countries.
Yeah, we said that a few times already this week. There's going to be a sticking point for talks between these two nations potentially this weekend. You're seeing it show up in trade volume. China's total exports rising more than expected in April, even as shipments to the U.S. slumped 21%. Exports to India and 10 other Southeast Asian nations soaring by more than 20%, while shipments to the EU were up 8%. This is the change we're expecting and the change ultimately we're already seeing.
Which raises the question how much they are able to offset any decline in exports to the U.S. on an ongoing basis. This also could be a bunch of front loading. And that's why this is difficult to really get a handle on, because a number of companies were saying, look, let's get as much in as we possibly can. Can this continue? And if so, What are the problems for the European Union with this?
That's just trade. So we try to turn to taxes. Let's do that now. The president calling for raising taxes on some of the wealthiest Americans. Sources telling us here at Bloomberg, Trump is proposing a new 39.6% tax bracket for people earning at least $2.5 million or couples making $5.
And Kayleigh asked Secretary Lutnick about this last night, and he called it a, quote, smart move to free up more money to pay for Trump's other proposals like no tax on tips that he talked about on the campaign trail. The issue with this goes against the orthodoxy of the Republican Party. So there is going to be pushback from conservatives in Congress on raising the tax bracket. Even though these are high net worth individuals, this goes against the core beliefs of the Republican Party. And this just shows like Trump at his core is a populist. This is going to be very challenging. Punchbowl News puts it this morning. The reconciliation bill is not ready for prime time.
To that point, what is the relevance of the core beliefs of the old school Republican Party now under the President of the United States, Donald Trump, in the White House at the moment? Because this is not the same party anymore. We already know that.
It's a great question, but the majorities are so slim in the Senate and the House that he needs to get everyone on board, and this might just be too high for them to go.
Herding cats down in Washington. Let's talk about something much, much more serious. The U.S. Transportation Secretary Sean Duffy calling for a major overhaul of the air traffic control system. Airline CEOs joining Duffy on stage as he outlined plans to build 6 new centres and replace more than 600 radars. Joining us now is Tom Fitzgerald of TD Cowen. Tom, welcome to the programme, sir. I want to start with the airlines. Clearly, we've had a series of aviation safety issues over the last 6 months or so. Tom, are you seeing that start to impact travel volume, start to hurt some of these airlines?
Hi, Jonathan. Thanks very much. It's not impacting travel volumes as much as it's just adding an operational constraint and more bottlenecks, especially for the airlines that have a heavy presence in the Northeast, like United, JetBlue, Delta. We see it in New York. We've seen it in other years in places like the Jacksonville Tower down in Florida. And it's not, it's never a safety issue. But what happens is when you have these outdated technologies, when we have short staffing in ATC, the industry has to just slow how much capacity it can put through the system. And that's just, it's bad for the airline's financials, but it's also tends to be pretty bad for the traveling public and their just experience with their trip overall.
Tom, from an objective standpoint, can you quantify how much less safe the aviation industry is today than, say, 5 years ago? And I ask this at a time where administration officials have come out and said, look, it is incredibly safe to fly. A number of emergency responders say it is, again, safer to fly than to drive a car. Can you quantify the deterioration around the edges?
Yeah, I don't have any numbers on quantifying that, and I think it's a pretty tricky thing to quantify. You might be able to quantify the impact to an airline's hub economics, maybe if you could just rough out back of the envelope how much capacity they had to pull out, but then a lot of it's assumption based. But again, this isn't a safety issue. I mean, the North Star for everyone in the industry, all the stakeholders, is safety. But it's just the impact is that we just have a much less efficient aviation system as a result.
Going forward, how much is this going to dampen earnings in addition to just a general reluctance right now at a time when Air Canada just came out and said that passenger revenue on U.S. routes fell 4.6% in the first quarter, understanding that Canadians' inbound travel to the U.S. is a bit of an idiosyncratic effort. How much are we seeing that only compounded by some of these safety concerns?
It'll be a challenge. I mean, I think it's a really frustrating time at Newark for United right now. They've had to cancel 35 departures per day. They've had issues in past summers, and we've seen them route more connecting traffic through Dulles over the Atlantic instead of through Newark. But, I think it's less of it's manageable for them. It's just, they can't fully optimize. They view Newark as their crown jewel for international travel, and they just can't. They're leaving a lot of meat on the bone, I would say, in terms of its full potential. It's a bigger challenge for an airline like JetBlue, where, in their Jet Forward plan, they talk about improving reliability to drive better NPS scores so customers feel more confident booking them. As long as it's a really as long as the infrastructure and the ATC towers are prone to these bottlenecks and very inefficient and just causing all these like snowballing effects with cancellations and delays, that's going to make it really hard for JetBlue to kind of maintain their reliability. So this is a really welcome development. And I think the problems have been known for a long time. There just hasn't been the political will in the past to get a bill like this done. But I think it's going to take a long time, but I think the industry has a lot to be excited about from Secretary Duffy's conference yesterday.
Well, Tom, it needs congressional approval. And also, how much is it going to cost? Because right now they've been very scant on details of the price tag.
Yeah, so our checks indicate it's probably going to cost around $30 billion. And then the bulk of that's going to go to telecommunications and technology upgrades, with the rest split between facilities and staffing. But, as they noted yesterday, it's not, there's brick and mortar elements, but this is really a technology and telecommunications initiative.
Is there the impetus on Capitol Hill to sign off on $30 billion?
I think so. I just, based on what we're hearing, it sounds like there is a bipartisan appetite. And I think, the crash at DCA earlier this year, as well as the events at Newark, the events at the Philly Tower over the last couple of weeks, I think that's really spurring a lot of people on the Hill to want to take action.
Tom, can we just finish on what the previous administration did and didn't do? I think perception and reality are important to talk about. The perception was that the former administration focused very much on consumer rights and maybe didn't do enough on transportation safety. Tom, what's your read on that, and would you push back against that?
I think there's some of it's true, some of it's not true. I mean, they for sure pushed on consumer rights, and that was a pain point for the industry. And I think the industry's view is that the Secretary Duffy is going to be less of a micromanager. I don't think it's fair to say that they didn't try to solve the issue. I don't know if they went for as big of a funding bill as this, but they definitely made the attempt. But I think a lot of it got stalled in partisan gridlock. But I think the bigger issue is what's coming forward. I mean, this wasn't an issue that started in the last administration. This has been decades in the making, and the can's been kicked down the road several times. But if we finally get the policymakers to take action, and in 3, 4, or 5 years' time, we have the aviation system that we would like, I think that's a great outcome for everybody, operators, traveling public.
Let's hope we get there and quickly. Tom, appreciate the response. Tom Fitzgerald there of TD Cowen. Years, decades in the making.
It's pretty incredible when you hear someone say that now all of a sudden there's this political will, even though for years people have been talking about this, complaining about it, and there's been anxiety when it comes to air travel in the United States. Some of his notes there were also talking about how this Secretary Duffy, the industry sees him as someone who's throwing himself into the job, getting into the weeds, and wants to really see this get across the finish line.
He's had to hit the ground running. That's for sure. That's for sure. If you're just joining us, welcome to the programme. Equities are elevated by a third of 1% on the S&P 500. Going into the weekend, key trade talks between the US and China. More on that still to come. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara. Hey, Yahara.
Hi, John. European Commission President Ursula von der Leyen saying that she wants a trade package ready if she visits Washington. This after the EU laid out retaliatory tariff plans against the U.S. President Trump unfazed by the bloc's response, telling reporters, quote, everyone wants to make a deal, and calling von der Leyen fantastic. Meanwhile, India and Pakistan claim to have shot down each other's drones and missiles over densely populated cities, escalating hostilities between the nuclear-armed neighbors. The U.S. and other global powers have called for restraint, with President Trump saying he wants both to work it out and offering to help if needed. And in sports, the Europa League final will be an all-English affair after Manchester United and Tottenham secured spots yesterday. It'll be the third time in the last 50 years the final will be two English teams. The winner will land a spot in next year's Champions League. The match is set for May 21st. That's your Bloomberg Brief. John?
I've got mixed feelings about this. Yahara, thank you. Should we just rename the tournament? Can you call it the Champions League? If you're allowed to secure a place and you finished in the league just above relegation the year before.
Wow,
seriously.
Throwing shade.
What are you going to root for?
Really?
I think even Tottenham and Manchester United fans feel this way. It's kind of ridiculous. Anyway, up next on the programme, pleading for a rate cut.
Even interest rates are down. Now, if the chairman of the Fed, Jerome, if he would lower interest rates like numerous other countries have done, it's like jet fuel. It would be great.
That conversation up next. We'll catch up with Tom Tzitzouris of Strategas, live from New York City this morning. This is Bloomberg. As of the close, Thursday, heading towards a week of losses, just down by about 0.4% on the S&P, following 2 weeks of gains. We'll see if we snap that winning streak. This morning, we are higher by a third of 1% on the S&P 500. On the Nasdaq, up by 0.4. Under surveillance this morning, pleading for a rate cut.
Even interest rates are down. Now, if the chairman of the Fed, Jerome, if he would lower interest rates like numerous other countries have done, it's like jet fuel. It would be great. This country will hit a point that you better go out and buy stock now. Let me tell you, this country will be like a rocket ship that goes straight up.
So here's the latest this morning. The president saying Fed Chair Jay Powell is always too late as the U.S. economy faces rising odds of a recession. Tom Tzitzouris of Strategas, a Baird company, writing Fed funds futures show 100 basis points of cuts this year. We see 4 more cuts, and we're not going to pound the table on whether they all happen this year. Tom joins us now for more. Tom, good morning. Good to see you.
Yeah, good morning.
Middle of June, I think it's the 17th, 18th, something like that for the Federal Reserve. How different will things be compared to what they looked like the previous Wednesday?
Well, I think marginally different, but I think you're going to see jobless claims continue to trickle a little bit higher. And I do think that the labor market report that's coming out early next month will show the first signs of cracks. But with that said, the data has continued to remain stronger than expected. So the labor market's not showing any sign yet that households are losing jobs, employment's weakening, and you're not seeing a pullback in consumption. You're actually seeing an increase in consumption ahead of the tariffs.
That's one side of the dual mandate. Next week's CPI. Is it too early to expect this to show up in the inflation report?
It is, which means if it does show up, that's going to raise some eyebrows, and it's going to be another concern for the bond market. But I think it's going to be too early for that to show up.
Is there a risk of an upside, potentially, to both growth and potentially inflation at a time when a lot of people seem to be talking about the downside? And I say this at a time when President Trump says, go out and buy stocks, tells people he cares about what's going on in markets.
Yep. Well, the risk of an upside meaning the economy continues to remain robust. Yes, absolutely. The consumer could continue to spend. You could see tax cut discussions really gather some steam here, and you could see businesses just decide that we're going to spend, we're going to continue to be business as usual, which would keep us pretty close to full employment, where we still are roughly at full employment. So there is a risk to the upside. Also, the service sector remains very tight. There's not a lot of slack in the service sector labor market. So wages still are not wobbling lower. That can continue to push the consumer forward.
What's the bias right now when it comes to the long end of the yield curve? Whether there's a sort of a soft landing being priced in with continued expansion, or whether people are starting to really look at some sort of deterioration in the macroeconomic backdrop, along with this ongoing lack of desire for U.S. assets?
Yeah, well, let's say 10s at 435 is really not pricing in a soft landing, in my view. Even under the most, bearish outlook for bonds in a recession, you should see 10-year yields closer to 3.5%. Even in a shallow recession. Now, keep in mind, typically, from the point at which the economy begins to wobble to the point at which yields trough, 10-year yields might typically drop 200, 250 basis points. If you assume the peak in yields was 5, that tells us 10 should be down more like 3%. Even in a typical recession. So if you factor in all the consequences of tariffs, steeper curves, not just in the U.S., but globally, a 350, 360 might be more reasonable. So at 435, we're not pricing in any sort of soft patch at this point.
Do you think there are other bond markets that might better perform in the face of an economic downturn beyond treasuries?
Well, yeah, I think obviously economies where you have a slower growth pace, more of a persistent weakness, stagnation are going to be outperformers in this environment. That might be the UK, that might be core Europe, that might be even parts of Asia Pacific. But in general, I think duration as an asset class in the G10 regimes is going to be an underperformer, all else equal, because this is a phenomenon that's affecting us globally.
Tell us why. Why do you think that's going to be the case?
Well, tariffs in the U.S. are obviously one factor here that leads to a steeper curve globally, because obviously we've got reciprocal tariffs and we have reduced trade, and that does increase inflationary pressures. But also you're looking at another round of sovereign stimulus, which is probably the last thing you need in terms of easing fears of a bond market sell-off. And so you're going to continue to see upward pressure on long duration because of weakening fiscal creditworthiness and inflationary pressers.
Where do you see the tariffs, though, going? Because the president's made it clear they're unsustainable and they're coming down.
Yeah, I think they're coming down. Where they're going to deposit, I have really no clear view. But if I had to guess, that something close to that 10% universal tariff is probably where we're going to end up. But we're probably going to get there very incrementally and slow. It's not going to be a fast process. I know the equity markets wants to think that this is going to be a quick process, and once we get one trade deal, they're all going to fall in line. I don't think that's going to be the case. I think it's going to be very slow over the next, say, 6 to 12 months. If we're lucky, we can complete much of this by the end of the year. And I think somewhere around a 10% universal tariff is where we kind of finally end.
Especially when it comes to China, it could be a long process, maybe even more than 18 months going into 2027, according to Ed Mills. When the president yesterday talked about go out and buy stocks, he was talking about looking at the entire policy perspective of this administration. He was talking about tax cuts. How do you think the Fed views tax cuts? Because we constantly hear them talk about the uncertainty of tariffs, but this administration has a pretty aggressive tax plan.
Yeah, this is from an outsider looking at the Fed. I think the Fed academically views tax cuts as more inflationary than fiscal government spending, which seems counter to what I intuitively think of it as. But I do think the administration is going to look at tax cuts as being another source of inflation that causes them to be slower to ease along the way. And I would disagree with that, but that seems to be how the Fed academically views the topic.
You put this all together. You buying bonds? You basically saying we're going to see some kind of softer data? Or are you saying, you know what, this is all really complicated. I'm going to go into the negative yielding bonds in Switzerland?
No, I think we'd be buying bonds here. And we've been telling clients duration is attractive to us. 10s at 435 is attractive to us. It's a lot less attractive than when they were 480, but they're still attractive. The longer term picture here is clearly negative for bonds, but we've got to get through what is going to be a soft patch. There is economic damage that has been done, both from the uncertainty of tariffs as well as the consumer who's also beginning to pull back and is going to feel the pain of higher prices.
So you reject the idea that there's been some sort of structural change internationally where there is a less desirable appetite for treasuries. It sort of goes to John's question earlier when he said, are bonds in the U.S. going to really rally the most in some sort of weak patch at a time when you see massive outperformance in Germany, you see massive outperformance in Japan, and there's this feeling that maybe the certainty of policy there is going to trump, for lack of a better word, that in the United States. You don't buy that, it sounds like.
I don't buy that as a primary driver of yields. I think yes, on the margin, there's less demand for dollar assets. I think Larry Summers had said something to the effect of, if you have a lower trade deficit, you have a lower capital surplus. Absolutely true. So you're going to have less demand for dollar assets, particularly longer duration assets. But I think that is small compared to the realization that there is still no alternative to the U.S. dollar as the global reserve currency. And as long as that's the case, I often say the dollar is the ultimate Irish potato. The weaker it gets, the more you need it.
Tom, appreciate it.
Trying to wrap my head around that
I think I
one.
can make sense of that. Thank you, sir. Tom Tzitzouris there of Strategas, a bad company. On the Fed speak, we're going to hear from the Fed governor, Adriana Kugler, a little bit later on this morning at 7:45 Eastern time, so about 50 minutes from now, catching up with Francine Lacqua over in Iceland, of all places. Kugler having this to say this morning in a prepared speech. The labour market is stable. Unemployment has risen only sharply. She's one of the governors on the committee that's very focused on inflation and inflation expectations and getting some comfort maybe from where the labour market still is.
Yeah, this feeling that maybe they're in a good place, as we heard Fed Chair Jay Powell say. I wonder how many times she's going to say wait and see or wait, whether it's also going to be 24 or whether it's going to be more or less, because at a certain point, Fed communication raises a question mark as to its purpose when there is a lack of clarity on all sides.
We can count. Do you want to play a drinking game at home? If it is late into the evening, wherever you are, 7:45 Eastern time, that interview will be taking place. In the second hour of Bloomberg Surveillance in just a moment, Alex Altmann of Barclays, Sarah Bianchi of Evercore, David Tinsley of the Bank of America Institute, and the Fed Governor, Adriana Kugler from New York City. This is Bloomberg.
Risk reward is very unattractive to bet on stocks actually moving higher.
At some point down the road, we are going to see new all-time highs.
Definitely stay invested in the markets. Play a little bit more defensive here.
I'm not moving away from kind of the U.S. exceptionalism argument. I don't think it's dead.
We don't know how it's going to play out in any way, shape, or form, and that's the uncertainty premium that's in the market right now.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Two-day winning streak on the S&P 500, looking to make it day three going into the weekend. Live from New York City this morning. Good morning. The second hour of Bloomberg Surveillance starts right now. Equity futures near session highs, up 0.25% on the S&P 500. On the Nasdaq at the moment, positive by 0.4. Going into the weekend, this week never ends. We're going to have talks between the US and China this weekend. And on the table, a reduction in tariffs.
A real question here about how high the benchmark is. We were talking earlier with Max Kettner saying it's almost baked in that we're going to get some sort of drop down from 145% rate on tariffs on China to something like 50%. If that doesn't happen over the weekend, as Annmarie was talking about, what does that mean for stocks at a time when they are just down 3.7% from where we were right before Liberation Day on April 2nd?
The consensus has been building for a while that we'd ultimately land somewhere around a 10% baseline tariff on the world and maybe 50, 60 on China. We might be there in a few weeks.
Back to square one. This is what Trump talked about on the campaign trail. And after all that up and down roller coaster of the month of April, we might end up ending where we started. When it comes to China, though, and this is really a great point, if the talks are just about talks and setting up another meeting and there's no reduction of a tariff rate, what is that going to signal to this equity market? Because the president said yesterday, the rates, you can't get any higher, and if talks go well, maybe we could see them go down. Well, what if the talks don't go well, or they're not substantive, and they're just an airing of grievances, and they come out and they just say, well, we decided we're going to meet again, but no change of policy?
In the meantime, the planet's still spinning, the economy's still moving, and we've got to focus on the data. You see it in the trade volume coming out of China. Will we see it in CPI next week, or is it still too soon? And are you going to see it in the labour market data in the weeks and months to come?
This is the real question. At what point does the hard data reflect what a lot of people are saying in the University of Michigan Sentiment Survey, or is that going to be always considered the outlier? I was looking at this one report who pointed to the fact that car prices might go up, and we saw that from Carvana. They're taking advantage of this. Even as you see airline fees go down because people from Canada aren't coming to the U.S. and travel domestically has been coming down. You have this push-pull, oil prices down, but on the flip side, you have these supply disruptions that are causing specific prices to go up.
If you're just joining us, welcome to the program. Equities right now just a bit softer. We're down by 0.25%. Coming up over the next 60 minutes, we'll catch up with Alex Altmann of Barclays, with markets on hold ahead of China trade talks. Sarah Bianchi of Evercore as more trading partners approach the bargaining table, and the Federal Reserve Governor Adriana Kugler as the Fed snaps into wait-and-see mode. We begin this hour with stocks steady. Investors awaiting weekend news out of US-China trade talks. The president expecting meaningful progress, hinting he could lower levies on Chinese goods. Joining us now, Alex Altmann of Barclays. Alex, good morning.
Good morning.
Very tactical stuff that you do alongside your team. So just walk us through the risk-reward profile now, going into the weekend, given where markets are and where they have been.
I think you guys have already covered it pretty well. The risk-reward is that we're not going to get anything substantive over the weekend. And I would dare I say, Treasury Secretary Bessent has already kind of outlined that. And I think people often lose sight of the bigger picture. They're so focused on the minutiae. And actually, if you listen to what has been said by the administration, they said don't expect necessarily anything dramatic this weekend.
When we spoke to you last, there was a feeling that a lot of people were bearish, but very few were short. What does that sound like now in your conversations?
So I would say that the important thing, and this is a really good phrase, is that price and positioning drive narrative. And so where we're at right now is that obviously we've had a massive resurgence in price, a 13-14% rally in the S&P. Fun fact, April was actually the second best month for the S&P of the year. And it was only down 75 basis points. And consequently, we're now at the point where we have to sort of consider what is the path from here. We're back at the exact same levels that we were. And I personally think that people are still sitting on that slightly long neutral positioning. And in terms of narrative, it has, of course, shifted as a result of price. So people are thinking about the world and saying, oh, actually, we may end up with a better tariff outcome. We may end up with 10% universal and 50% on China. And if you take that as a blended global number, can we live with that? Sure, we could live with that. But my personal view, that's still a worse outcome than pre-Liberation Day. So we shouldn't be trading any higher.
You say the narrative. There are about 15 narratives, and they're all kind of overlapping, right? There's the tariff narrative and what happens on the policy front, but there's also the earnings narrative, and we're wrapping up earnings season with a lot of companies affirming their guidance and actually portraying an ability to be resilient and push through this, and even some seeing benefits as a result of some of the trade tensions. How do you square the idea that companies are managing through this with this overarching kind of macro paralysis that is leading people to be really concerned about the path forward?
It's a great question. So a couple of things. First of all is that the first quarter earnings obviously were not reflective of a new tariff regime, so to speak. And then if we think about the forward guidance, we had a large number of companies that was pulling their forward guidance for whether the Q2 or for the full year, in fact. I mean, think about what the airlines as sort of a case in point. So that, I think, is sort of one reflection of what's going on. The other thing I think we've got to think about is just like from a broader macro environment, like markets operate in very short-term time horizons. We're thinking about things day to day when companies and economies move at sort of monthly and quarterly pace. And the bottom line is that the impact of tariffs is yet to really be felt, and more importantly, yet to really be known. I mean, how could we possibly talk about what the backdrop for these corporates is going to look like on a forward-looking basis when they, nor the Fed, for that matter, know what the economic backdrop looks like?
Which raises the question, if Ed Mills is correct, when he came on earlier and he said that it could potentially be 2027 or 2028 when we start to see the true contours of some of these trade deals, what does that mean in terms of the ongoing uncertainty and lack of modeling ability by these companies?
And this has been, I think it's a great question, because that's really been the theme of what we talked about the past few times sitting right here, is that uncertainty really is the killer of everything. If you're a corporate boardroom and you don't have good certainty on what your forward looks like, then how are you supposed to make investment decisions? And I think that's a really critical thing about tariffs, is that if you're running tariffs on an emergency basis, and bearing in mind we have the CIT ruling on IEEPA coming up on the 13th, the same day as CPI, tariffs creates this logjam because you can kind of switch them on and off very quickly. Whereas if you create congressional frameworks for legislation to invest in your country, it's sticky and it creates a better backdrop for corporates. So the biggest problem I have with tariffs is not just the rate and the impact it can have on prices and price elasticity for consumers, but also it creates a less certain environment for corporates to actually invest in, and that's a consideration people don't really have right now.
But at this moment, the president has come out and did this deal, let's call it, framework of a potential deal, trade agreement with the United Kingdom. And he talked about the fact that with China, it's unsustainable and the rate's going to come down. Don't you think we're past peak uncertainty?
I think we're definitely past peak uncertainty, and that was a question we talked about a couple of weeks ago. But it doesn't mean we're past peak negativity. And I think that those two are quite distinct. So I think what the S&P has done, and again, we're down, 4% or so for the year. The S&P is still one of, if not the worst performing developed markets in the world so far for the year. Meanwhile, if you take MSCI EFA, it's making new or close to new all-time highs right now. So that uncertainty, I think, has been factored into that kind of differential now. We've still got to work out what is the real path for the economy, and then we start thinking about what is the earnings trajectory. So if we just sort of take the S&P earnings forecast and we take like a best case example for next year, let's say $290 of earnings next year, which is higher than where basically we were, say, a month or two ago for the 2026, we're still trading at relatively rich multiples with that uncertainty. And so I think the biggest issue I personally have, my team has, is that we're kind of capping out where realistically we can go with the US equity market, with one caveat. If you remember, 2007, GFC, it was pretty much on our doorstep. S&P decided to make new all-time highs or retest the all-time highs in September of that year. So we have to respect the fact that things can get kind of wacky very short term, and at the end of the day, we have to be intellectually flexible.
I'll add to that, intellectually flexible as where else do you go? The German DAX just hit an all-time high. It's now the most expensive relative to its peers in terms of stock indices in Europe, going back to 2009. It's sort of this question, if you think the U.S. is expensive, well, check out what's going on in Europe as everybody flees there with this momentary feeling that maybe this is going to be really positive for their growth.
So I love this question, right? Because what I love the most about it is that we can talk about valuations and globally and all the rest of it, but let's talk about liquidity for a second, right? So, and this is a stat which I think is really important. If you wanted to sell $1 billion of NVIDIA, you can pretty much do it, estimated impact cost, 15 basis points. If you took that $1 billion and you wanted to invest it in, say, ASML or anywhere in Europe, any large single company, ASML as a case in point, it would take you around about 2 weeks running 10% of the volume. So the liquidity differential to try and move money around is also a key factor as to why these indices are moving the way they are. Because sure, I can take my money out of the US quite easily, but to redeploy it elsewhere is very problematic. So I think, again, back to, we've talked about this in the past, like you have to get quite creative. You're going to have to be quite patient about where you want to go. And also, if things move that quickly because liquidity is diminished, we have to respect the fact the opportunity set may just be smaller because it closes much quicker. And that's exactly what we saw in Europe in January and February.
Can we finish on multiples? The superior American multiple. Have we seen enough damage, sufficient damage to attitudes to European investors for American equities to really put a lid on the American multiple?
I think that's a great question. At the end of the day, over the longer term, the equity multiple for the US will be dictated by the path of obviously the earnings growth and also the return profile. The US businesses have structurally grown their margins and their profits over time in excess of what, say, European companies have done. And that has reflected in the multiple. Has it been a fair reflection? Actually, if you plot the differential in returns between the two regions, and the multiple differentials, we've now closed that gap to what I would consider to be a pretty fair representation of that.
That's enough markets. Can I just ask you a question as a Brit? Did you ever think you'd hear the British Prime Minister call into the Oval Office and celebrate a 10% tariff on the auto sector?
I'm not going to pretend that that was a highlight for the British, but I will say that I think that the deal leaves a lot to be desired. Comparing the two texts didn't line up particularly well. I think they both tried to sort of get their best wins from the situation, but the reality is that if the UK, which had been negotiating a trade deal for 5 years with the US and is considered one of the best trading partners, and bearing in mind, Liberation Day, they were only given a 10% tariff to begin with, right? If this is the best case outcome that we can hope for, then I'm not exactly sure what the market should be cheering.
What does it mean for everybody else? I think that's the question we're all asking. The president is so good at anchoring expectations to the extreme that you end up in a situation where the British Prime Minister is happy about having his football team game interrupted, one, and two, ending up with a 10% tariff on the whole auto sector.
That's true.
As if that's good news.
There's this 11th hour call, and it was while Keir Starmer was watching his beloved Arsenal. Anyway, they lost, so maybe he was a little bit happy about that, to be drawn away from the game. But then they were able to get this deal over the finish line. But you make a great point. When you read the text back to back, or you speak to an official from the UK or the US, there seems to be this wiggle room of the direction of travel where they actually will end in the end. I think the UK still believes they can get below 10%. Where this administration says no one's really getting below 10% right now.
So we've got Peter Navarro coming up on the programme in about 45 minutes' time, and I think this is the question for him. You've already got a pretty good relationship with the UK. That's why the UK was first in the line. You've already got a fairly balanced trade balance with the UK as well, which made it easy to come to some kind of agreement. If this is as good as it gets, what does it mean for the talks with the Chinese over the weekend? Not just the duration of the talks, but the content of the talks, and how much harder is it going to be to strike deals with other nations?
Yeah, and what counts as a contour of a deal if the most difficult aspects that are really being negotiated are not clarified, right? I mean, what exactly are you agreeing on that gives you any kind of structure of what the rules of the game are for just even negotiations going forward? And if your mind is spinning, so is everybody else's, because right now it is so hard to understand what was actually agreed upon over in that UK-US agreement. I think that is my takeaway.
I'll return to Marcus just quickly. A question we've asked repeatedly through this weekend is whether the hope of trade deals would continue to sustain this market. You've kind of poured some cold water on that idea. I just wonder how you'd position going into the weekend, what you're telling clients and investors going into this round of talks with the Chinese.
So what we're basically advising is that we're going to either come in Monday with an announcement or we're not of some kind. So my base case is that we're going to listen to Scott Bessent and sort of say we're not going to have much coming out on Monday. And then Tuesday we have CPI. So actually what we're advising to clients is that volatility has come down to allow you to reprotect your portfolio. And more importantly, the volavol has come down as well, which basically means that the cost of protecting has actually cheapened quite substantially. So because of that, we actually quite like very, very short-dated tactical downside into next week.
So why are you listening to the Treasury Secretary and not the President when he says to me 145%? It's going down from here, and if the talks are good, he's prepared to drop it?
Because I think it's a bit of tautology, because, of course, if talks are good, talks wouldn't be good if they didn't come down. So there has to be sort of stick and carrot. I just would advise that the day before. So yesterday, the president said that if talks go well, we'll lower tariffs. The day before, he said, I'm not lowering tariffs. Because
it was about preemptively lowering the tariffs before they sat down for the meeting. He said, no, he would not do that. So I think, again, we're at the whim and mercy of effectively one man's decision,
That's
which
true.
makes it incredibly difficult to navigate this environment.
We're going to be doing that for the next few years, Alex, all right?
Yes, exactly.
You prepared for that? Alex Altmann there of Barclays. We've got a few years of this. To Lisa's point, we caught up with Ed Mills earlier on this morning and made the point this could drag on to 2027 and maybe beyond.
Which raises the question how much of an uncertainty premium needs to be baked in, and how much can people really say we're almost back to where we were on April 2nd? How much has actually fundamentally and structurally really changed?
Equities on the S&P higher by 1/3% this morning. With an update on stories elsewhere with your Bloomberg brief, here's Yahara Arnold. Hey, Yahara.
Hi, John. NVIDIA plans to release a downgraded version of its H20 chip for China in July. Sources telling Reuters the chip giant notified major Chinese customers of the plans. The H20 had been NVIDIA's most powerful AI chip cleared for Chinese sales, but was essentially blocked from the market after U.S. officials said it would require an export license. Meanwhile, Air Canada is saying its passenger revenue on U.S. routes fell close to 5% in the first quarter. Just earlier this month, the airline announced it was cutting routes to San Francisco in addition to Miami and Washington. Air Canada also seeing cargo operating revenues up 16% year over year as a result of shippers front-loading cargo to avoid possible tariffs. And UBS is telling bankers to stop flying business class on short trips to China. Sources telling Bloomberg the move comes as deal-making and capital markets activity in China has slowed amid its trade war with the U.S. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate it. More from Yahara later this hour. Up next, de-escalation with China.
Mr. President, if the talks go well this weekend between Secretary Besson and Ambassador Greer with their Chinese counterparts, not preemptively, but if the talks go well, would you then consider lowering the tariff rate on China?
Right now, you can't get any higher. It's at 145, so we know it's coming down. But we're going to have I think we're going to have a very good weekend.
It might feel like a long weekend for investors. You are not getting the weekend off. Equity futures are positive, and we're looking ahead to talks between the US and China with Sarah Bianchi of Evercore up next. Two days against on the S&P, looking to make it day three. Equity futures at the moment positive by 0.4%. On the Nasdaq 100 up by 0.5. Under surveillance this morning, de-escalation with China.
Mr. President, if the talks go well this weekend between Secretary Besson and Ambassador Greer with their Chinese counterparts, not preemptively, but if the talks go well, would you then consider lowering the tariff rate on China?
Right now, you can't get any higher. It's at 145, so we know it's coming down. It's going to be very good for both countries. I would like to see China open. I do think they have far more to gain than we do in a sense, but I think we're going to have a very good weekend.
Will you speak to Xi after the weekend talks?
I might, yeah, sure.
Here's the latest this morning. Officials from the US and China set for their first trade negotiations tomorrow in Switzerland. Sources telling us here at Bloomberg the US is aiming to cut tariffs below 60% as a first step, which China may be prepared to match. Joining us now from the nation's capital, Bloomberg's Tyler Kendall. Tyler, we've been talking about talks for a long time now. Walk us through how things are set up going into Switzerland.
Yeah, hey, John. Well, as you mentioned, if talks do go well, Bloomberg News is reporting that the U.S. feels that China may match a tariff rate below 60%. And in fact, it could go into effect as soon as next week. Now, people familiar caution that at this point, everything is so uncertain. But it does appear that the administration may be trying to bring those tariff rates back to where they were on so-called Liberation Day. Of course, that was the 34% so-called reciprocal tariff stacked on top of that 20% tariff that went into effect earlier in the year over fentanyl concerns. Now, to be sure, we do not know the exact rate, and this White House has said that any talk about a target tariff rate is really just speculation at this point, but still, it is giving us some sort of sense of perhaps where this administration is headed. Now, President Trump has said, of course, that he does think that tariff rates need to come down, saying that the current situation does amount to a trade embargo. But we know this White House is looking for concessions out of Beijing during these talks, and that could be a range of things, including having China tighten its controls when it comes to fentanyl flows or even loosening curbs on critical and rare earth minerals. Our reporting indicates that that is a high priority here going into the weekend. Now, what actually happens does remain to be seen. Bloomberg Economics cautions that they do not expect immediate agreement or a permanent de-escalation to result from these talks. But of course, officials, including President Trump there, have been expressing pretty high optimism going into the weekend.
Tyler, thank you. Heading into the weekend, we can extend the conversation with Sarah Bianchi of Evercore ISI. Sarah, we've had positioning now for weeks ahead of these talks. Here they are. Who's got the leverage?
Well, look, at this point, I think China has a bit more leverage, but the reality is both sides would like these tariffs to come down from these levels that, as they all say, are basically an embargo. So I think both sides will be delighted to, just use even good mood music out of these talks to take things down, to de-escalate. So I do expect at some point next week we'll see these tariffs come down to the 60% range on the U.S. side, and I think I do think China will match in some way.
Sarah, how are you thinking about this weekend? Is it talks about talks, or do you really think that they are going to hash out some trade issues?
I think they are going to hash out minimal trade issues. As you know, the one thing we've been saying in all these countries is actual trade talks is hard and long, but this is not hard. This is trying to get down to something just manageable while they begin talks. So I think they will talk about rare earths. They will talk about some of these other issues, perhaps a few purchase agreements. But in general, everybody wants this to come down from these unsustainable levels. And then, which by the way, 60, 50%, still really, really high. Then that can at least do put us on a path for an actual discussion, an actual outline of what they're trying to achieve.
To drop that rate, does the U.S. need to see a concession from Beijing?
I don't think so. I think, look, they have to make sure it doesn't appear that it's just a purely unilateral a walk away. But I think they can use the cover of a good conversation, a commitment on, a small commitment on fentanyl. I think it can be largely symbolic or, policies that perhaps are already in place pretty much. I don't think there's a lot here because, again, I think Beijing has a lot more patience and pain tolerance in the United States, but nobody's really happy with where we're at right now.
Sarah, we're hearing from the president right now saying China should open up its market to the USA. It would be good for them. Closed markets don't work anymore. Sarah, you lived some of these negotiations with the Chinese before as the deputy US trade representative in the previous administration. How difficult is it to get China to move to where the US would like it to be? What is it that they're refusing to open up that we'd like to see them open up?
Well, I'm not sure that opening up is really kind of what, honestly, where the tensions really are, to be honest. Last time the president got China to agree to a bunch of purchase agreements, particularly around ag, I had the honor of trying to see if those were enforceable. There was not a lot. There was pretty clear that China wasn't going to do that. And so one of the challenges is not just what the agreement is, but does anybody actually ever listen to it? The truth is what China really wants from the U.S. is more access to some of our technology and chips. And that's why we always think this, quote, grand bargain is very, very difficult. We think the best you can do is sort of a package of trades and exchanges and maybe a little bit more market opening. But that's really not the core of the issue.
Sarah, appreciate your time as always. Sarah Bianchi there of Evercore on the latest going into these talks this weekend. If we revisit these purchase agreements, is that sufficient, Lisa? And if we do, how difficult is it going to be this time around to enforce them?
This is ultimately the question. What is the meat of this negotiation? Is it going to be some of the actual trade deficit? Is it going to be the tech aspects? Is it going to be where the exports are coming from, if they're coming from Vietnam, but from China? It is so difficult to know the contours of this. So it sounds good, but what does that even mean in the context of the current rules?
When the president tweets or truths China should open up their markets, all I can think about is a $300 billion trade deficit. That is a number he is squarely focused on and cares about. And if China could get that lower with a purchasing agreement, I think that would help this relationship move along.
Big weekend coming up. The talks about talks set to take place in Switzerland between the United States and China. Equities at the moment firmer by 1/3% on the S&P. Up next, David Tinsley of the Bank of America Institute with consumers buying ahead of incoming tariff costs. Live from New York, you're watching Bloomberg TV. This just in from the President of the United States. Check this out. We're going into talks with the US and China this weekend in Switzerland. Tariffs are around 150%. The President says this: 80% tariff on China seems right. It's up to Scott B. Scott B being the Treasury Secretary, Scott Besson. Here's the reaction to it in the markets. Equity futures just coming off session highs, rolling over, still positive by 1/10%. Think about the context for this. The reporting going into the weekend suggesting that maybe tariffs would drop below 60%. The president suggesting going into talks, it could be around 80.
So higher than what the market was expecting. The market expecting 60%, maybe even lower, and even lower potentially on knickknacks and textiles, a little bit higher with national security goods. Now the president is putting basically the weekend talks around 80%. And really, I guess, depends on how the Treasury Secretary deals with the Chinese, because it's, quote, up to Scott B.
What is the difference between 60 and 80 for Chinese negotiators this weekend?
I mean, hard to say at this point, hard to say what this does for Scott B and his potential negotiations. It is notable to me, given the fact that the baseline was 50%, that you're not seeing a sell-off, because it seems like this is a comfortably numb market to headline risk right now.
Equity futures rolling over just a touch on the S&P 500. Still positive. The up and about 2 hours away. With your morning movers, here's Danny Berger. Hey, Danny.
Hey, John. Well, we're not numb on some of these individual names, especially when it comes to earnings. Expedia, by far the worst performer in the S&P 500 pre-market. They cut their outlook. They now see the high end of growth in 2025 at 4%. Previously, that was their low end of estimate range. It's something we've heard from airlines, from other travel companies, that there's just less demand in the U.S., both domestically and from inbound travel. They said Canada in specific, they'd seen travel there be cut by a third for demand to travel. So those shares down again, nearly 10% this morning. We also, after the bell yesterday, got results from Monster Beverage. They, of course, make those Monster energy drinks. A weak outlook for them. They, in fact, missed on their earnings. Shares are down 4.5%. They said that the reason for the sales miss was the fact that alcohol sales were down. Again, I didn't realize that they made alcohol, which is a scary idea for this energy company, but even so, alcohol sales were down. They gave a bunch of reasons. One of them was economic uncertainty. They also said costs are going to be moving higher because of tariffs on aluminum, to be specific, so margins will look worse. Finally, rounding things out with Coinbase, which also reported their earnings. Again, a miss when it comes to their revenue. In fact, revenue shrank in the first quarter, but they said it's because the comparables were really tough versus the fourth quarter. Donald Trump had just been elected. Crypto trading was off the rails, but they said in the first quarter, trading fell by about 17% for most consumers. Even though Bitcoin was hitting new highs, they said that the volatility was keeping folks on the sidelines. So those shares down more than 1.5%, John.
You don't fancy a vodka and Monster beverage?
I feel
Danny?
like that should be illegal if it's not already.
I don't want to bump into anyone that's had vodka and Monster beverage. Danny, thank you. Thanks very much. On a radar this morning, President Donald Trump saying 80% tariffs on China are about right. Now it's up to the Treasury Secretary, Scott Bessent, setting up talks going into the weekend.
So this is how the White House at this moment is looking at the talks in Geneva. Potentially, it's going to drop the rate to 80%. It's at 145%. Yesterday, I was in the Oval Office with the president. He said that right now you can't get any higher, and we know that it's coming down. Two things. Most analysts will tell you at 80%, that is still a trade embargo between these two economies. Also, you have to remember, second point, strategic uncertainty. We know this administration likes to use this idea and lean into game theory. Potentially, before, quote, Scotty B goes over to Geneva, the Treasury Secretary, alongside Ambassador Greer, the president is trying to cajole the Chinese to maybe give more concessions, and maybe he'll be a little bit more warm or helpful on the 80%.
We've not got much to work with here. We're working off a social media post. But I do wonder what about right means. About right for what? About right for the talks, to set up the talks between the two leaders, or about right going forward for the foreseeable future?
Scotty B, what's your take? I mean, at this point, we're having to wonder and parse through some of these truths to understand the mood music heading into this. But what does it mean that 5 minutes apart, we get one that says China should open up its market to the U.S., all caps, and then 80% tariff on China, low caps? Seems about right. Up to Scotty B. There is this drumbeat, this mood music to try to get leverage, but also conciliatory tone heading into these talks, which is really highlighting how high the stakes are right now for a market that is on pins and needles trying to understand the path ahead.
It's framing for negotiations going into Switzerland. We had a deal with the UK yesterday. We caught up with the Commerce Secretary, Howard Lutnick, who signalled that other key trade partners might have to wait for tariff relief.
But obviously, when you talk about Japan, I mean, come on, you've got to spend an enormous amount of time with Japan, Korea. These are not going to be fast deals. Now, India's been leaning in really hard, right? You know, I love doing a deal with India. That's certainly a possibility, but this is a lot of work. These are a lot of lines.
The Commerce Secretary is right to point this out and set expectations. This is going to take a lot of time. And I just wonder if we've got enough time left. Remember that 90-day tariff pause? The clock is still ticking. If you listen to the Commerce Secretary there, you have to understand that it could go well beyond that time period.
Right, because trade deals take years. What's so interesting about this, he seemed to throw cold water on the tone the president was setting in the Oval Office, which is that trade deals are going to be coming fast and furious. What's so interesting about Japan, they were the first in. Remember, the president sat in on the negotiations when the Japanese team came to Washington, D.C., and everyone thought this close ally, very close, very strategically, in certain geographic terms, close to China, that they would be the first out with a deal. No, it wasn't. It was United Kingdom. And I think what he's doing is just saying this is going to take a lot more time. Not everyone is going to get the Keir Starmer treatment.
All I can say, my takeaway, Boeing. they seem to be the big winner from all of this stuff because every single deal seems to involve some sort of buying of a Boeing plane. So I'm curious for Boeing's standpoint how the CEO is really understanding how they're going to juice production to meet all of this buying that's going to come in from all of the contours of deals and talks and deals.
I'm not a fan of central planning. So there's parts of these conversations that I'm a little uncomfortable with.
You're uncomfortable with Boeing?
Not Boeing per se, just uncomfortable with purchase agreements. I don't want to see private companies come together and strike deals because government officials have pointed them in one direction and the other.
Boeing and Rolls-Royce engines, it's sort of this sort of outlier.
I want to see tariffs down and free markets, that we want to see that happen, and hopefully we end up with that. But yeah,
from specific places.
That's the struggle. Let's get to this. Much lighter news. The Catholic Church has a new leader, Cardinal Robert Prevost, becoming the first ever American Pope. Born in Chicago, but spent 20 years in Peru, he chose the name Leo the 14th.
He is from the south side of Chicago.
How cool is that?
It is very cool. What's interesting is that President Trump has been welcoming him as the American Pope, but at the same time, and he put out something that was really nice, at the same time, in the past, he's had some interesting and sort of controversial statements about immigration and kind of butting up against President Trump. So it's going to be a very interesting American representation in the papal office.
Beautiful scenes coming out of Rome. We're on that story, of course, throughout the day on Bloomberg TV and on Bloomberg Radio. Let's turn back to trade. Companies from Apple, Nvidia, GM and Procter & Gamble warning of a tariff hit. David Tinsley and the team at the Bank of America Institute writing the following. The gradual easing in consumer spending is not just due to lower inflation. The growth in the number of transactions has also cooled. David joins us now for more. David, welcome to the programme, sir. Just walk us through what you're seeing in your data, what you're seeing in spending over the past month or so.
Yeah, thanks for having me on, John. I mean, all the stuff you were discussing before this interview was about the uncertainty facing economies and the US economy. And when I was listening to that, I was thinking it wouldn't be unreasonable to expect the consumer to be taking some of that in and slowing. And we have seen some moderation in spending growth in our data. But in a way, I think the major takeaway is that consumers do continue to have forward momentum. And actually, when we look at our data and look at the financial health of consumers, it's sound. It's pretty good. There are a few, margins where there are more concern, but the body of consumer health is solid and consumers are continuing to spend.
David, one big feature of this cycle coming out of the pandemic is to consistently underestimate the resilience of the US consumer. When you look at checking balances and the data that you have and compare them to pre-pandemic, just how healthy are things?
Yeah, that's a great question. So basically, right now they're being swollen a little bit by tax refunds. And so when you look at the data right now, even the worst case scenario for you, the lowest increase relative to 2019, cash terms, is up around 70%, I think, off the top of my head. And obviously that's, in inflation-adjusted terms, still a big increase. I think the other thing on financial health that we take some comfort from is when you look at people who pay off their credit cards every month, or when you look at people that don't pay off their credit cards every month, that percentage is actually down about 7% on 2019. So most people are paying off their cards and they have cash in the bank relative to where they were pre-pandemic.
Averages have kind of broken down a little bit given the huge gap that we've seen in spending and resilience among the upper income echelons versus the lower tier of earners. I'm just wondering how you see that difference developing. Are you seeing ongoing resilience to a really strong degree in the top earners, or is this resilience really across the board?
So it's certainly the case that the lower income households in our data are showing the slowest growth. It is still positive, but it is the weakest. And so we are at the top end, and I think the middle, we're still seeing some sort of steady resilience. I think when you look across to the labour market, what we also see is that the lower income households have shown the largest deceleration in their wage growth. In our data, the year-on-year growth in April was around 1.5% for lower-income households, quite a bit weaker than the higher-income households, which I think was about 2.3%. So it's all, to a large extent, a labour market story, but there is more resilience, I think, at the middle and higher end of households.
David, this is one of my favourite reports, so thanks for sharing it with us this morning. We appreciate it, sir.
Thank you very much.
Thank you, sir. David Tinsley there of the Bank of America Institute on the state of the consumer right now, and the read is pretty resilient compared to and relative to some of the fears out there at the moment. Let's talk about some of the fears going into the weekend. Just where will tariffs land once we have these talks between the US and China? Let's get you an update on stories. Elsewhere this morning with your Bloomberg Brief, here's Yahira.
Hi, John. President Trump floating an 80% tariff on China ahead of this weekend's negotiations between the two countries and saying China should open up its market to the U.S. Trade talks, as you said, are set to begin tomorrow between the two nations. Meanwhile, TSMC's revenue jumped 48% in April, underscoring how electronics firms scrambled to acquire essential components before global tariffs took effect. The main chip maker for Apple and Nvidia reported monthly sales of $11.6 billion. The company has stressed that demand remains resilient despite tariffs. And New York City slashed its forecast for international tourists in 2025 by 17%, blaming Trump's tariffs and hardline policies on immigration. The decline in foreign visitors is expected to hurt the city's economy, as international visitors typically stay longer and spend more money than domestic tourists. That's your Bloomberg Brief. John?
Yahira, thank you. More from Yahira in the next hour. Up next on the programme, too late, pal.
The Bank of England cut, China cut, everybody's cutting but him. It's a shame. I call him Too Late, Too Late Powell, that's his nickname, and it's a shame, it's ridiculous.
Up next, the Federal Reserve Governor, Adriana Kugler, sitting down with Francine Lacqua in Iceland. From New York, this is Bloomberg. Just in, moments ago, heading into the weekend for talks between the US and China, the president writing this on social media. 80% tariff on China seems right. It's up to Scott B. It's up to the Treasury Secretary, Scott Bessent. Equities responding, just rolling over a touch. Not a big drama. We're still positive by 0.25% on the S&P 500. On the Nasdaq, we're up by 0.3. Out of surveillance this morning, too late, pal.
The Bank of England cut, China cut, everybody's cutting but him. It's a shame. I call him Too Late, Too Late Powell, that's his nickname, and it's a shame, it's ridiculous. He's always too late. But in this case, it's not going to matter that much because our country is so strong, we're so powerful in terms of economic strength.
Here's the latest this morning. President Trump criticising Fed Chair Jay Powell for staying in wait-and-see mode while central banks across Europe and China cut interest rates. Joining us now with a special guest, Bloomberg's Francine Lacqua. Morning, Francine.
Good morning. Thank you so much, of course, for coming here to Iceland, Reykjavik, where we're delighted to be joined by Governor Adriana Kugler. Governor Kugler, thank you for joining us. Look, there's been a lot of talk about central bank independence. Jay Powell under attack many times by Donald Trump, saying, look, that actually the Fed did not cut. How do you think, and how would you explain to the markets and maybe the president of why we're currently in a wait-and-see mode for the Fed?
Thank you, Francine, for having me here. And so let me tell you a little bit. Obviously, we held steady at 4.3%. And I supported that because the way I think about it is that our policy rate is currently moderately restrictive. And I think it makes sense to keep it that way. And it makes sense to keep it that way for a number of reasons. First of all, we have been seeing the progress on disinflation slow down a little bit. We have also seen an increase in inflation expectations, and we want to keep long-run inflation expectations very well anchored. So that's the second reason. Third, we see some risks, upside risks to inflation from the tariffs that are currently in place, and given that, it makes sense to make sure we keep, again, the federal funds rate moderately restrictive. On the real side of the economy, on the other hand, things have remained resilient. The employment rate is still high, and the unemployment rate is still currently at historically low rates. And by the same token, private activity is judged by PDFP, the private domestic final purchases number shows us that private activity grew at 3%. We saw some conflicting evidence between imports and inventories, but overall we see health still in the real economy. So that gives us time to make sure that we continue to make progress on inflation and we keep our inflation expectations very well anchored.
Governor, how problematic are the uncertainty actually of the tariffs to look at scenarios for GDP, inflation and rates? So do you look at scenarios or do you look at baseline projections?
Yeah, thank you for asking that. We look at a broad range of scenarios, in fact, because it is particularly important during this time period of a lot of uncertainty. Uncertainty is the word of the day, as you know. And so the way we see it is that we don't know which way this is going to go. We started at 2.6% effective tariff rate at the beginning of the year. It depends who you ask, but it's somewhere between 20 and 27%, according to many analyses. And we do our own analysis, but also look at private sector analysis on this issue. So it's still very high. It may still change. It could come down because there could be negotiations or exemptions. It could go up some if additional tariffs get put into place. So we're not sure even about the magnitude of the tariffs. We don't know which products are going to be affected by the tariffs at this point. We have a baseline case, as you said, as to the ones that already have been implemented, but we don't know if that's going to change in the next week, in the next months, in the next year. So we're keeping close attention to many different scenarios and paying attention as to how that may affect the economy. So obviously that is the question of the day. How will it affect the economy, right?
So Governor, first of all, what's your main takeaway from first quarter GDP, and how are you see U.S. consumers behaving right now?
Yeah, as I said, on the real side of the economy, what we got is GDP for the first quarter, so it's backward looking. Yeah. And that backward-looking number is showing us exactly what one would have expected, which is a lot of front-loading. So front-loading of imports ahead of the tariffs. People trying to buy, both producers and consumers trying to get those products before the tariffs get put into place. That showed up in a huge increase in imports and some increase in inventories, but not as much. So overall, the GDP number showed some weakness of 0.3%, minus 0.3%. But if you look at the private side, on the other hand, you see a very resilient economy with 3% growth in PDFP, the private domestic final purchases part of the economy, which shows a resilient consumer and a resilient investor as well. Now, if you look at some of the more real-time data, the picture could look a little different. We did see high retail sales, but if you ask the consumer what they think they're going to do ahead, there's a fall in consumer confidence. And people are thinking, well, maybe we'll hold back. Investors are thinking, well, investment may come down because we don't know what is coming ahead, and they're concerned about tariffs.
And Governor, I mean, there's a lot of talk, of course, that employment will rise. You could also see tariffs actually putting inflation up. So at some point, if it happens in the third quarter or the fourth quarter, if you have this employment going up, but also inflation being pushed by tariffs, does the higher unemployment bring disinflation? Does it somehow make the job a little bit easier for the Fed?
So there are two effects, right? One, upside risk to inflation, and upside risk to unemployment or slowdown in economic activity. You're right. I think the way I think about it is we're already seeing, especially from surveys of manufacturers, some indications about tariffs putting upward pressure on prices, in particular on the cost of materials. Those costs already being passed on to the consumer. That's already showing up in those surveys, whether it's the ISM surveys, the surveys that are done by the regional feds. So that's definitely showing up in the data, and it's showing up in goods prices and goods inflation going up as well. That's happening. Now, down the road, you're right, there could be a slowdown. And that slowdown partly because of uncertainty, but also because real disposable income is going to fall. Also, because the real value of financial assets may fall, and that will decrease wealth. And so those two effects are going to push down aggregate demand. In addition to that, I would point out that there could be reallocation of economic activity and a reduction in productivity. And that could come up if, for example, new businesses or existing businesses start producing things that used to be produced by those abroad, and then you're having lower productivity. That could put potentially some downward pressure on prices coming up from the other side. But it's not clear whether they'll exactly counteract each other. I would say one has to be cautious to think that in itself is going to do the trick of getting prices back down.
Governor Adriana Kugler, thank you so much for joining us today. With that, I'm going to send it back to you, and we'll have plenty more from Reykjavik here in Iceland.
Looking forward to it. Francine, thank you. Francine Lacqua alongside the Fed governor, reinforcing the balance of risks articulated by the Fed chair in the news conference on Wednesday. Upside risk to inflation, downside risk to growth. But I think emphasis always matters. And once again, a Federal Reserve official choosing to emphasize anchoring inflation expectations.
At a time when they haven't gotten inflation down to that 2% target for a couple of years, and they seem pretty close to that place. Key question, how does that emphasis change when we actually start to see some of the weakness in the hard data? It's very easy to put the emphasis on the strength when you hear things like credit card receivables are going strong. There are plenty of companies that are reaffirming their guidance. It's much harder when all of a sudden people are losing their jobs and you see the unemployment rate ticking up.
The policy can change quickly as well. The President of the United States this hour saying an 80% tariff on China seems about right, and it's up to the Treasury Secretary Scott Bessent going into these talks this weekend.
Well, we certainly know it's going down. He said that yesterday, and he's reiterating that today. Now he's putting a figure on it, so 145% potentially dropping to 80. The question, of course, is this: is Trump just trying to rattle the Chinese delegation before they sit down with the Treasury Secretary and Ambassador Greer? Because our reporting was that actually they're looking to something closer to 50 or 60%. All we know is it's going to be a working weekend, and by Monday morning, there might be a lower rate when it comes to China than there currently is now.
He likes to anchor negotiations, and he's anchoring negotiations around 80% going into the weekend now, and we'll see what we get. Equities are just about holding on. The S&P 500 positive by 0.2% and looking for a third day of gains. Up next, a must-watch. The senior Trump trade advisor, Peter Navarro, Alicia Levine of BNY Wealth, Dan Ives of Wedbush, and Tiffany Weldig of PIMCO. Live from New York City, the third hour of Bloomberg Surveillance. Up next.
It's going to be a real bumpy road on this whole tariff process.
At this point, rubber needs to meet the road. We need to actually see some numbers here.
This is a process. It's going to take time.
This is a really big shock that's coming at the economy.
The damage is already being done. The rest of the world now sees the U.S. not necessarily as a very credible trading partner.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The third hour of Bloomberg Surveillance starts right now, and your scores look like this. The S&P 500 on a two-day winning streak, looking to make it day three. On the S&P, we're positive by 0.2%. On the Nasdaq 100, higher by 0.3. Going into the weekend, important trade talks between the United States and China taking place in Switzerland, and a flavour of things to come maybe from the President of the United States, President Trump, just moments ago on social media saying an 80% tariff on China seems about right. It's up to the Treasury Secretary.
Two ways to read this. On one hand, you could say 80%, as Annmarie said, the last hour is basically a trade embargo. It's still substantially higher than what people were expecting, with a 50% potential rate after the talks. On the other hand, you could say the openness to even lower the rate is a positive step toward really ratcheting down some of the pressure, which is the ultimate goal of talks about talks.
Well, the president yesterday said it's at 145% and can't go higher. It's got to come down. If talks go well, then potentially could come down this weekend. The issue is a lot of reporting and smoke signals from the White House has been 50, 60%. Now the president is saying actually maybe around 80%, but let's see how the Treasury Secretary does. It's up to him.
Let's see how it goes. Right now, equity is just about positive going to all of that. We begin this hour with markets looking ahead to high-stakes trade talks between the US and China in Switzerland this weekend. Joining us now, I'm very pleased to say, Peter Navarro, the Director of the Office of Trade and Manufacturing Policy at the White House. Dr. Navarro, it's been too long, sir. It's good to see you. Thanks for being here.
Been a long time, Jonathan, and it is good to see you too, sir.
Thank you, sir.
First-class digs here, my friend.
Well, I'm pleased we're looking after you. Let's kick it off with these talks this weekend. We just heard from the president just moments ago, and he mentioned an 80% tariff might be about right. It's up to the Treasury Secretary. We understand you won't want to get ahead of those negotiations, but I just wonder, could you offer some clarity on what about right means? When the president says 80% tariff on China seems right for the talks this weekend or seems right for the foreseeable future?
Yeah, I was one of 3 people that was with the White House the first term for all 4 years. One of the big reasons is I never got ahead of the president. But let me tell you about Geneva, which is kind of, so I've got a very warm memories. It was my finest hour as a negotiator. I went there to lead the negotiations for the United Postal Union reforms that essentially got China rates fair to, we save billions on that. But I mention this because Geneva has symbolic value in this negotiation. It is the headquarters of the World Trade Organization. And the scariest thing I ever saw in Geneva was the size of the China delegation at the World Trade Organization. And they've played the WTO like a fiddle. So let's see what happens tomorrow. So I'd be happy to come back on Monday and do the debrief, but I don't want to get ahead of the boss or Scott Bessent. And don't forget, Scott's going with Jameson Greer, the United States Trade Representative. He's the guy who learned at the knee of Bob Lighthizer the first time around, was there for all the China stuff, and he's the guy who was the architect, along with Howard Lutnick, of the UK deal. So let's see what happens. It's
2 of the very best, sir. We'll certainly pencil in.
Interesting weekend for the markets.
We'll pencil in an appearance with you for Monday. No worries about that. I'm looking forward to that conversation. Just going into the weekend and reflecting on your experience dealing with the Chinese. They're not the UK. This is not the same relationship. The trade relationship is tremendously unbalanced and has been for a long, long time. Can you frame for us how difficult it has been previously for you to negotiate with the Chinese and how much longer it could take with the Chinese relative to, say, the UK and other trade partners?
Well, I can tell you, I think I sat face-to-face with the China team maybe 7 times during the first term, and twice Xi Jinping was there. It was G7, the G20. Both, I think it was Tokyo and Buenos Aires. What's so interesting to me, Jonathan, about China is that they have continuity. The same people are going to be in Geneva were the same people back then, and our regimes change. We have different governments and things like that, but they have the advantage of that kind of continuity. But look. It'll be interesting. Again, I don't want to get ahead of Scott and Jameson or the president. I think let's see what happens. My role, and we've got 15 countries we run enormous trade deficits with that we've got to renegotiate the whole structure of those deals. And there's another 100 countries that cheat us in some ways, but smaller ways. My role in the administration on all of this is to do the background analytics to see how each country is cheating us, which basically sets up the terms of the negotiation. And every country is like fingerprints. Like India is the Maharaja tariffs. They have the highest tariffs of any of our major trading partners. Japan is the most clever at protecting its own markets with a combination of domestic protectionism, non-tariff barriers. Germany, they have auto tariffs at 10%. We have them at 2.5%, but they also have the VAT tax, which acts as another 19% tariff, and an export subsidy. So what I do is do the background and look at kind of how these countries are doing what to us. And we get great deals for the American people. I think the UK deal is very interesting. I think the significance is not just that it's a deal, but that it's a template for for the future deals. What we do, Jonathan, is there's like 4 or 5 verticals we look at: is the tariffs, the non-tariff barriers, the digital taxes, and then the various kinds of cheating, the dumping, the currency manipulation, things like that. And then from there, we assess what the asks are and what we need, and go forward from there. You're going to see a steady wave of deals. The USTR building is right across the street from the White House. It's got the most staff negotiating these deals. And it's like you go to the deli and you have to take a number and get in line. Every day there's delegations from around the world lining up to meet with Jameson Greer and Howard Lutnick. And I've seen, I looked yesterday at the schedule. It was kind of fun out to July, and it's just, one after the other.
Well, Peter, looking at the countries lining up, one key aspect of the UK deal was, of course, bringing down the auto tariff to 10%. So right now you have a tariff rate that's lower for Bentleys, which is a car that most American families can't afford, made in the UK, where Chevys have a higher rate if they're made in Canada or Mexico. Is there an expectation that the next trade deals, auto tariffs, will be coming down, those rates?
It's going to be country by country. I mean, the beauty about the UK is that it's a very small amount of exports they send us, and we have a hard cap at, I think it's 100,000 units, where it goes right back up to 25%. And again, we're trying to do something that's mutually beneficial to both countries to get to a better place, while at the same time changing the level of the playing field so that it is more level. I think for me, the beauty of the UK deal, besides that, was all of the good stuff we had for ag. I mean, one of the problems we have is this non-tariff barriers, like phytosanitary standards. What's that? That's like these things they do to keep our pork out, our chicken out, or our beef. Right now, we're going to be able to sell a lot more beef, poultry, dairy, and ethanol. I mean, they had a really high tariff, like almost a lockout tariff on ethanol, and that's made from corn. So the folks in Iowa are very happy about that. So this is the way we're going to go forward. On net, the United States is going to be far better off. And all we're doing is trying to level the playing field. I saw the EU kind of rattling sabers, I think it was yesterday, about some kind of retaliation. And I would just say to anybody who's in the European Union, I mean, how can you look us in the face and threaten us when your tariffs are higher? You have lost cases repeatedly at the WTO on us selling you things like beef and poultry, and you won't even honor that. So,
Peter, yesterday the president called Ursula von der Leyen fantastic, and he said he hopes to meet her. But are you saying that the European Union is not as high on the priority list than, say, other trading partners like South Korea and Japan?
Not at all. I mean, the EU, to be clear here, we have the second highest trade deficit with the EU behind China. So they're very high on the list. All I'm saying here is that I found it unfortunate that the EU kind of fired, I think some term was fired, shots across our bow. It's like retaliation will not work against the United States. We shouldn't have that. Let's talk. Let's figure this out. And it would be nice. Here, let's give peace a chance here. All we're asking for here in the United States of America is fairness. I mean,
hold on.
Would you agree? Is there any disagreement on this set and on your set that the tariffs of the EU are higher and that the non-tariff barriers are higher and that the WTO in Geneva is basically sanctioning that through two things?
Okay, but
one
Peter,
is the but would you agree with that? I mean,
I think
have I said anything
there's
that
a bigger
you would like
question.
to fact check there?
There's a bigger
They
question
cheat
here.
us.
There's a bigger
Yes.
question here, and this is something that the German finance minister has come out and talked about, which is they'd be willing to drop all tariffs to zero if the U.S. were willing to drop all tariffs to zero. There is a willingness to negotiate around the board to a lower tariff regime. Would that be acceptable to you, or is 10% the new floor?
So let's stay with that. See, that's such a misdirection, okay? It's the non-tariff barrier, stupid, to kind of paraphrase Bill Clinton. It's the non-tariff barriers. So when countries like Vietnam or entities like the EU say to us, oh, let's all go to zero tariffs and everything will be okay. That's not the problem. It's part of the problem, but the bigger problem is the non-tariff barriers. In Europe, it's the VAT tax. I mean, I don't know if you know this, but the United States has tried going back to the 1970s to get equity treatment for the VAT tax, which most countries of the world use, versus the income tax, which we use. We haven't been able to get it because the WTO has a majority of people who benefit from sticking it to the United States. So they do. So the zero tariff thing, that's misdirection. And on your set, you should call it on that. When they say, let's lower the non-tariff barriers and let's give you relief on the VAT tax, now we're talking.
The VAT tax is a slightly different mechanism. This is all going to take a long time, and there are a lot of competing factors here in terms of who can possibly pull these levers. And I'm just wondering, we've got 2 months left in this 90-day negotiating period that is paused for the retaliatory tariffs. Does that just get extended out another 90 days as you have to deal with different legislative bodies to possibly remedy what you see?
Well, we don't have to deal with legislative bodies. Well, okay, in the EU perhaps, but I coined a term in Trump time, which is to say do it as fast as possible without screwing it up. And that's all we're trying to do. I go back to the observation that the United States Trade Representative in that building, which is a historic building, by the way, beautiful to see if you ever get there, the lines, they're coming in and out, and we're talking and we're talking. And, as the boss says, let's see what happens. I mean, it's in everybody's interest around the world to level the playing field with the United States in a way which allows us to restructure this international trade environment, which is fundamentally skewed against the United States. I mean, we're losing, because of this system, the United States is losing our manufacturing base, we're losing our defense industrial base. And when push comes to shove and folks around the world are looking for the United States to help defend them, I mean, if we get to a point where we can't do that, what good is that? So economic security is national security is one of the guiding principles of President Trump and this administration. So we're just trying to get fairness here. Give fairness a chance here and work with us.
Looking forward to an update on Monday, sir. It's good to see you once again.
Yes, sir.
Thank you.
Right,
Dr. Navarro, Director of the Office of Trade and Manufacturing Policy at the White House. A couple of things to point out there. How much harder it will be to deal with the Europeans, because it goes beyond just tariffs. And I think you heard it there articulated very well from Dr. Navarro.
He's talking about the VAT tax, which has to do with exempting certain goods or getting a rebate if you're a European company. This is a complicated measure to try to undo in the same mechanism as any type of tariff talk, which raises a question: what happens in 2 months' time when the 90-day pause in retaliatory tariffs comes up?
When he talks about Europe, we didn't even ask the question. He just went there on his own about the retaliation he's seeing out of Europe. There's $100 billion worth of U.S. goods that they might target if talks fail. Even though yesterday in the Oval Office, the president said he thinks Ursula von der Leyen is fantastic and wants to meet with her. The VAT tax is the problem the U.S. has with Europe, not the tariff rate.
With us around the table, Alicia Levine of BNY Wealth. Alicia, good morning.
Good morning.
You were following that conversation. He certainly didn't want to get ahead of negotiations this weekend. What's the best case? Monday morning, what are we waking up to?
So, at 6 a.m., the best case was a 50 or 60% tariff rate and 10% universal. And then an hour later, it was 80% tariffs on China. The news changes quickly. Interestingly, the markets have been hanging in there. I mean, the futures actually have not reacted to that. And I think the message that the markets have learned is that this is one grand negotiating strategy, and there's good cop, bad cop in the administration. And it's very clear what the direction of travel is. And the direction of travel is lowering of the tariffs and getting to deals. I think it's also no accident that Dr. Navarro was on today before the negotiations in Switzerland this weekend, since he is seen to be the most hawkish when it comes to tariffs, and particularly on China. So if this is part of a negotiating strategy, I think the markets have learned it's a negotiating strategy.
So what do you make of that? The idea that there's been sort of, I don't want to say benumbing of markets, but the response to headlines has been coming in again and again. Does that give you actually a sense of comfort?
Oh, yes. I mean, look, what really happened, so now April 9th was the 90-day pause, was the message to markets that we're moving the whole probability curve over to the right. And the worst tailed scenario, that highest risk tail scenario, is actually off the table. That's why the markets were able to rally and bounced off the lows. That continues to be the case. And if you think about it just in terms of numbers, because this business is all about numbers, the original tariffs of April 2nd were about $600 billion worth of tariffs, $600 billion, which was basically a tax of 2% on the U.S. economy. U.S. economy is about $30 trillion of GDP. So $600 billion in tariffs was about 2% hit, which is why you had the odds of recession go straight up. Because if you think growth rates are about 2% and you put a 2% tax on it, you get to zero. Now, with all the walkbacks, we're at about $400 billion in tariffs. Okay, so we've walked back about 1/3 of that. And I think ultimately we get to somewhere of about $200 billion in tariffs. Still very high, but it's not a 2% hit to the economy. And that's what the market's been pricing in the whole time. Earnings are probably higher for next year than that immediate base case in April 2nd. And at some point, the markets are going to look to 2026. And by the summer, we're looking at 26 and not 25 anymore. And I think that's what's happening in the markets.
Are we getting a weekend this weekend? Doesn't feel like it, does it?
Not in this business. I mean, look, we've all glued to our screens for a long time. So there's no weekend. There's the Sunday nights checking the futures. Yeah. We're going to do that again. But I think the intensity of it, as I said, the markets have learned this is a negotiation with Dr. Navarro on to set the stake in the ground to commit the U.S. On negotiating strategy.
That negotiating is going to be going on for quite a while. Alicia's going to be sticking with us, not through all the negotiations, just for the next 5 minutes or so. Equity futures right now in the S&P positive by 0.2% with an update on stories elsewhere with your Bloomberg brief. Here's Yahira. Hey, Yahira.
Hi, John. President Trump saying on Truth Social Republicans should probably not raise taxes on the rich, but adding that he's okay if they do. His comments coming after sources tell Bloomberg that Trump wants a new 39.6% tax bracket for people making at least $2.5 million or couples making $5 million. Meanwhile, NVIDIA plans to release a downgraded version of its H20 chip for China in July, sources telling Reuters. The chip giant notified major Chinese customers of the plan. The H20 had been NVIDIA's most powerful AI chip cleared for Chinese sales, but was essentially blocked from the market after U.S. officials said it would require an export license. And in sports, the Indiana Pacers look to extend their 2-0 lead in their series against top seed Cleveland. Elsewhere, the Timberwolves evened their series against Golden State after Steph Curry strained his hamstring. And in New York, fans are in a frenzy with the Knicks up 2-0 against the Boston Celtics ahead of Game 3 tomorrow. The cheapest seats in the Garden start at over $600. That's your Bloomberg Brief. John?
I've looked at the prices. Yahira, thank you. It's absolutely ridiculous.
$600 for the cheapest tickets. The most expensive are tens of thousands of dollars.
Count me out.
Think of the people. What about the people?
Count me out. Ridiculous. Yeah. Okay, let's get you some morning calls. First up, JP Morgan cutting its price target on Target to 105, citing sales softness and promotional risk. That stock is up by 0.6%. Your second call from UBS raising its price target on Boeing to 226, saying it's able to navigate the changing tariff environment. And finally, Goldman upgrading Lyft to a buy, seeing strong execution and a stable industry backdrop. Let's turn to tech. The AI race between the US and China in focus as the Trump administration plans to repeal Biden-era chip export rules. Dan Ives of Wedbush writing, we're seeing China tech waking up to the AI revolution with the US. China trade tensions abound. Dan joins us now for more alongside Alicia Levine of BNY. Dan, it's good to see you, sir.
Great to be here.
Big weekend of trade talks. Where does tech fit in to all of this?
Look, I think tech knows that they're walking back from the cliff in terms of what they're going to need to do, right? Because the reality is that that's the hearts and lungs of the supply chain. And I think what you've seen, the NVIDIA moment, really essentially giving Huawei the China market, I think that was really, that was the start of this. I think it was the start of the administration recognizing they're going to have to pull back. And look, you can't argue with the data.
How self-sufficient is Chinese tech without US tech?
Look, they need U.S. tech, but let's just be, as someone that spends so much time in China, I mean, if you put them in a room with a seltzer bottle, toothpick, and in a straw, they come out with an AI chip. So the problem is that you don't want to put China in the situation that they're going to have to ultimately innovate, because it's my view, for the first time in 30 years, the U.S. has been ahead of China when it comes to tech. So the last thing you want to do is cut U.S. tech off at the knees. And I think now the administration is part of why we're seeing in the market. They've taken steps back, and I think now we're at least getting to some sort of balance. But still, look, definitely a lot more wood to chop ahead.
They're rescinding the diffusion rule under the Biden administration. So some of these geopolitical swing states are going to get more access to U.S. chips. How does China take advantage of that?
I mean, look, China definitely is going to, from a market share perspective, go after. I think we've already seen in terms of Huawei and others what they're going after. But the reality is it's really the H20, right? Like once you restrict the H20 in terms of NVIDIA, that sort of started this sort of Game of Thrones battle that we're seeing. And China definitely edging in terms of what I view as the AI revolution. BABA, I think front and center. But U.S. continues to own the AI revolution. And I think the one thing as we go into Switzerland, you go into talks, the last thing you want to see here is administration just double down. Because if you do that and you don't lower the tension, you don't de-escalate, it's U.S. tech that gets hurt. And right now, I think that's sort of the tenuous situation we're in, although much more positive than, call it 3-4 weeks ago.
And Alicia, it really points to what we've seen in the markets recently, which is as the tone has softened, we have seen a huge rip-roaring rally in tech, and everyone's been piling in. It's the AI stories back on. Let's go. Is that going to be the leadership again, or is this a tenuous rally in face of some of the uncertainties of how far some of these negotiating tactics can work?
So the one good thing about uncertainty is that it creates a two-way market. And I think many investors see this as a great entry point. The multiples are much lower. The stocks have been crushed. And, ultimately, I think the narrative that U.S. exceptionalism is over has been very strong. And we saw this rush into global markets. And the question is today, I'm just going to point out that the S&P has outperformed developed international month to date. And there's a reason for that. And that's partly because the tech earnings with the multiples and the cash flow, you can't get around it. And ultimately, as an investor, you're investing in future cash flows. And what we saw from these companies is that there's nobody else that can touch these companies.
Yeah, and to your point, it was a Jalen Brunson moment for the tech space.
Let's get the Knicks in.
And it was a Jalen Brunson moment. And
He's got $600.
You've seen ultimately what happened here in terms of the AI revolution.
2 flashpoints. Allow me to sort of detail a couple. DeepSeek's one. Okay, big upset. Beyond trade. Let's forget trade. DeepSeek's one. The second one, I think, this week, Apple coming out and saying search has peaked on Google. What was your reaction to that headline?
That was a shot across the bow, right? I mean, just given what we're seeing even on the regulatory front, it's the last thing Alphabet needed to see. Look, I think Bark's worse than the bite there, and it's our view, like search queries, like where AI is not ending Alphabet's hearts and lungs in terms of their core money train, but it shows Apple when it comes to AI and building it out, they're going to have to do their own path, and they're going to have to build some of that out. And you talk about DeepSeek to almost kind of put it in a bow. Look, every big tech firm wants to be the seat at the table. No one's going to say, okay, hey, Apple, Google, you could be our AI or open AI. And I think that's the reality that we're seeing here.
Alicia, just quickly, has the tech trade changed? Is it different now? Do you have to play it differently?
I think you do have to play it differently. I mean, it's no longer close your eyes and just throw the dart at the Magnificent Seven. I mean, there's clearly different growth rates here, but the power of the size of the companies, we think, is still going to actually drive the S&P here. So we think the American exceptionalism trade lives on, and maybe in different ways. But look at industrials have been rallying, aerospace defense has been rallying, tech has been rallying. I mean, this is the base of the U.S. economy and the S&P. It does suggest also, I'll just say, that some of the conversation coming from the White House is finding its way back into the market in a positive way and not just putting a lid on things. Like we said weeks ago, the 4,800 low is in,
it's
regardless of recession.
Alicia Levine, Dan Ives from New York. This is Bloomberg. Setting the stage for talks this weekend between the US and China in Switzerland. The President of the United States with this post earlier this morning. If you're just tuning in, welcome. If you've been with us for the last couple of hours, forgive me to keep repeating this, but this is how things are going to follow into the weekend. The president saying an 80% tariff on China seems right. It's up to the Treasury Secretary, Scott Bessent. We just spoke to Peter Navarro, the trade advisor to the president. Didn't really want to get ahead of negotiations going into the weekend. So this is how we're framing things going into negotiations.
He doesn't want to get ahead of the president, doesn't want to get ahead of Scott Bessent, who's leading the delegation when they sit across from the Chinese over the weekend. We know the rate is coming down. The president made that clear over the weekend, of course, unless the talks go really sour. But if the talks are okay and warm, the rate's coming down. Everyone thought this morning, 6 a.m., the rate was going to be 50, 60%. Trump is recalibrating everyone's thinking going into the weekend, and he's saying he thinks 80% is about right.
We always say you can learn something from the headline and how the market responds to the headline. Didn't really budge in the face of that headline. We're still just about positive on the S&P 500, up 0.2%. On the Nasdaq, up by 0.3. With 60 minutes until the cash open, let's get you some morning movers. Here's Danny Berger. Hey, Danny.
Hey, John. Pinterest, one of the big movers to the upside in the pre-market trade, up 13%. It had earnings after the close yesterday. For all these fears that there'd be something of a digital ad slowdown, it didn't happen. A surprise the upside on the quarter they reported and their forecast for the current quarter. All of that also reflected in what we saw in Alphabet, Meta, Reddit. All of those digital advertising giants also doing well. We also had a headline crossing the terminal just moments ago about CrowdStrike. Shares are moving lower on that headline. This is a Bloomberg scoop. There had already been an ongoing probe into CrowdStrike in a $32 million deal it did with a government reseller to provide tools to the IRS. The IRS said, one, it never got those tools, and two, it didn't even buy them. The latest turn in the saga, according to Bloomberg sources, is that regulators are now asking questions and probing executives at CrowdStrike itself, and now going back and looking at their other deals of CrowdStrike. Spokesperson saying that they stand by their accounting of that deal. Finally, rounding things up with Affirm, the buy now, pay later app. It also reported earnings. I got to say the results were pretty solid, and it said we can withstand any economic downturn we might get. Analysts were skeptical. JP Morgan cut its price target. They did run a scenario where you had a 50% increase in stress in the credit environment. If there is a downturn, it just said it would take on less credit approvals and it would only hurt them by about 10 percentage points. But those shares down more than 6%, John.
Danny, thank you. Thanks for this morning. Have a good weekend. Danny Berger there with three of the movers going into the opening bell. The news flow has been absolutely tremendous. Here's another headline right here. The United States to seek preferential treatment for the United Kingdom on any pharma tariffs. We've still got to deal with the sectoral tariffs with the United States, and the US to seek preferential treatment for the UK.
And the comment period is over, so any day those sectoral tariffs could be dropping. It looks like if you're a very close ally and have a special relationship with the United States, you are going to get a better deal, especially when things are of critical national importance. So maybe a sectoral tariff on pharma is going to be more preferential, a better treatment with the United Kingdom than, say, someplace like China.
This is the gold standard for deals at the moment. Whatever you think about the deal, this might be as good as it gets, the relationship between the US and the United Kingdom.
And what did we learn? That 10% baseline stays. What doesn't stay necessarily are the sectoral tariffs. The steel and aluminum can come down in return for some number of different concessions. So does this give us any sense of where the negotiations could go, or is this basically, as you say, as good as it gets?
It's finger up in the air type stuff going into the weekend, right? 80, 60, yeah. We'll see what happens. Imagine being a Fed official. How much sympathy can we have for them? Mike McKee has tons. He joins us now. Mike McKee, lots of Fed speak still to come today and into the weekend.
Lots of Fed speak, but I don't know that we're going to get a whole lot out of it. You've already heard from Adriana, Kugler, John Williams, people who are basically telling us they don't have any idea what's going on with the Trump administration, and so there's nothing they can do. It's a repeat of what Jay Powell has been saying. So we hear from a lot of people today, but can they add anything to the discussion? When you talk to people out here at the Hoover Monetary Policy Conference, there's a lot of frustration. They have to make policy, but they don't know what the policy is going to be from the administration, so they don't know what the effect is going to be on the economy. And I can tell you, Alicia just mentioned the 10% baseline tariffs. There was some talk at dinner last night of, remember back a couple of months ago when we thought 10% baseline tariffs and 50% on China would be a crisis for the world. So the president moving things around doesn't make anything easier for them.
Mike McKee from the most depressing-looking hotel room I've ever seen. Mike, they need to do some paint work there. I'm not sure if there's a tariff on paint at the moment, but let's figure this out. Mike McKee, thank you. That's all I could think about.
It's what everyone was thinking.
Who chose the colour of those
but
walls?
You actually said,
I mean,
you
of
actually
course.
said what everyone was thinking out loud.
You didn't think the same thing?
John, the sartorial
like
commentator.
That off yellow?
Yes, it's sort of I pulled up
no windows.
10% tariffs or, yellow walls.
I pulled up our internal booking system and I was like, I got to find him a better hotel.
It looked like a suite. I'll give him that. All right, let's stick with the Federal Reserve. Tiffany of PIMCO writing, our baseline view is the Fed is likely will begin cutting rates in September and continue into the next year as we expect the unemployment rate to rise and longer-term inflation expectations to remain relatively well anchored. Tiffany joins us now for more. Tiffany, welcome to the programme. Let's talk about the outlook for the labour market. So claims have held up, they've come back down. The payrolls report on Friday was pretty resilient. When are you and the team expecting to see some weakness emerge in this labour market?
Yeah, I mean, so we think the risk here is that it's more delayed than what the markets are pricing. I think there's the same uncertainty that Powell and the Federal Reserve are dealing with. Companies are dealing with that same uncertainty, and they don't want to make labor decisions when they don't have the facts. We just think about the calendar for when we could learn more. Obviously we've had some news around maybe some incremental deals and some positive things out of China. But if you look at just when this 90-day window is over for the reciprocal tariffs, that's like beginning of July. There's not an expectation for anything to come out on the tax and spending bill until around that time as well, July 4th. We think the reality of that is that it'll take Congress longer, maybe closer to the summer recess before that happens. So companies are not going to want to move, to the extent that they can. They're not going to want to move until later this year. So you think about the Fed with release lags, they might not have data in hand that suggests the labor market is weakening until the fall. So I think that's what's driving our baseline expectation. I think the other thing that we're keeping an eye on is the federal government worker layoffs. That has not hit the payroll report yet. There are estimates of 150 to 200,000 jobs there. We think many of those people are still on administrative leave, and they might not actually get separated from their job until the midsummer as well. And all of the economic effects of that are still to come. So those are the reasons why we're looking for more of a lag here in the labor market impact.
The labor market is expected to lag behind some of the more quickly moving sentiment. Maybe CPI is a little bit different. Next week, we do get a host of inflation reads, CPI and PPI among them, at a time when you have kind of dueling effects here. On one hand, oil prices have gone down pretty significantly. Airline prices for tickets have also been discounted, but car dealerships are seeing car prices go up. So does it evenly balance itself, or could we see the inflationary effects as soon as next week?
Yeah, I mean, I think that is the key issue here is how quickly do those inflationary effects show up? And as you suggested, we do have, we do sort of have varying evidence of that. I think one of the big things that we'll be watching within the CPI is specifically the retail goods categories. Yes, we've heard some anecdotal reports about the auto industry. We can see some more acceleration in the wholesale auto market. But there's really a question around the brunt of retail goods that have a major portion of their supply chains in China, how those prices will start to adjust. And, I think it's possible, you've heard some retailers suggest that because they have inventory on hand, that they will wait until they're actually using inventory that's tariffed to start to raise prices. So that suggests we could see a little bit more of a lag with that as well. But we'll just have to see. I think it'll be really important to focus in on those retail price categories.
How long can the U.S. continue to have an inflationary backdrop while the rest of the world sees a disinflationary backdrop, or the appearance of it? And I'm struck by the gap in interest rate expectations around the world that seems to be widening as the ECB is set to lower rates again. We had the Bank of England, we have the Bank of Canada, but the U.S. very much on hold.
Yeah, I think the important point on the tariffs is, although it acts like a supply shock for the United States, we're basically inducing the relative price of imports higher. It is very much a demand shock on everywhere else in the world, especially those countries that export to the United States. I think there's a real question around if demand for if U.S. demand for those goods is lower because the government is inducing higher prices on them, then where do those goods go around the rest of the world. And we think China, for example, will try to sell elsewhere, and they'll probably try to sell elsewhere, at lower costs. So although this is a near-term potential inflationary price level adjustment for the U.S., effectively it's the opposite. We have a relative price adjustment that's happening here as well, and that just means that central banks around the world can focus more on the growth hit that will likely come from this, and the disinflationary effects as well.
Tiffany, as we go into these talks over the weekend between the U.S. and China, is there a tariff rate that would not act as an embargo between trade in these two economies, but would still be a rate on goods coming from China into the United States?
Yeah, I think, it looks like if you just take the administration, if you just look at what they've done and you take that for what it's worth, it suggests very clearly that this administration, wants to engineer a decoupling from the Chinese economy. And they want to do it rather quickly. Now, whether that's 145% tariff on Chinese goods or down to 80, that is a significant increase in the average effective tariff rate. And it will provide an incentive for supply chains to move out of China, potentially into other Southeast Asian economies, maybe Mexico. Certainly we could get some of the production back to the United States. But again, this will happen at higher costs. We estimate based on census data, that on average, Chinese prices of goods are about 20 to 30% below the global average. So you have moving your supply chain out of China could give you 20 to 30% more in terms of costs, and then you still have this 10% average effective tariff rate as well. So all of that is going to induce more costs on the U.S. economy, but we think it will ultimately engineer, an accelerated move in that direction out of China.
Tiffany, appreciate your take as always. Tiffany Wilding there of PIMCO, going into the weekend and looking ahead to some CPI data as well. The president is annoyed with the Fed chair, Jay Powell. He's going to continue to be annoyed because these central banks abroad will keep cutting rates. One, because of the nature of the shock, disinflationary. Two, the move in the FX market. The dollar has been a whole lot weaker, which gives them the space to reduce interest rates. And then three, this is the issue they've got now. The way the Federal Reserve has set the reaction function up now, they're just going to wait. They're going to wait, and they're going to wait.
They need to see the hard data, in particular with respect to jobs, reflect the weakness that a lot of people expect, and that it will not come until much later in the year. So now the question is, how much of an inflationary shock is there in the very near term that sets them even on a longer course before they make that first cut?
Matt Diczok's with us around the table of Maryland Bank of America Private Bank. Matt, good morning to you, sir.
Morning, Jonathan.
Let's talk markets. Will treasuries provide that diversifier for people with a portfolio this morning?
We do believe they will. No, not over a short time. You're not going to see, bonds move intraday in the way you're going to want them to move. But end of the day, you can get 5% yields on the ag right now. More importantly, what's the limiter? 2 to 2.5% real yields from 10 to 30 years. We've been saying that for 18, 24 months. Now that's still there. So it's very difficult, we believe, for that not to provide good diversification over a longer period of time. Where else are you going to go? You're going to go to Europe? What kind of real yields are you getting there? Less than 1% on average. Keep going around the world. Japan, negative real yields.
So you've mentioned the income you can get. Talk to me about the correlation with risk assets.
Correlation with risk assets, again, it's breaking down a little bit here, but we do not think it's fundamentally broken. Even over short periods of time, a week, a month, it's not going to move in lockstep. Over a multi-year period, it's going to diversify. It will come down. Real yields will come down, in our opinion, strongly, if we do get economic weakness, because the trade, tariffs, anything, over a longer period of time, 2 to 2.5% real yields on government-guaranteed securities are quite attractive as a hedge to macro and risk assets.
Why wasn't that happening in April? What went wrong?
April was a lot of technical selling. We talked about this last time. The S&P dropped 10% in about 16 days. Long bond said, hold my beer. I'm going to drop 10 points in 60 hours. We went from 4:30 on Monday morning to over 5%. A lot of technical selling. Should we worry about that? No, we don't worry about that. My clients, a lot of my clients are investing clients. They're capital and liquidity providers. Higher recession risk and higher real yields, that's good for my clients. Let's break it down. If we're worried about foreign selling of treasuries, we're not saying it was foreign selling, but if that's the concern, who's the largest holder of U.S. treasuries abroad? Japan. Over $1 trillion, not going to use them. Next largest holder officially is China, about $750 billion. Guys, the treasury market is 29 trillion outstanding. 750 billion is a lot, but not enough to move the needle.
Maybe so. There is this feeling, though, that there was a natural bid into treasuries because it was a dollar-denominated asset at a time when there was a huge trade deficit and people were getting dollars from overseas and needed to park them in something that was perceived as safe. You don't think that anything has shaken that thesis?
I do not believe that thesis is fundamentally broken. At the end of the day, we do not believe fundamentally that the U.S. dollar is a reserve currency by choice. We are, again, fantastically lucky, grateful, wealthy country. People want our wealth. Our wealth is denominated in U.S. dollars. If they want access to our wealth, they're going to need to accept dollars. You can denominate assets anything you want. We're going to pay dollars, so we believe it's a reserve asset by necessity.
There used to be a phrase, don't fight the Fed. Increasingly, as central banks around the world are cutting rates at a time when the Fed is not, as we were just talking about, do you chase that? A lot of people have come on and said that's the reason why foreign bonds seem so much better than U.S. government bonds, because in the U.S., not only is the Fed not cutting, but potentially we will expand the deficit. Why does that not concern you?
So I'm not saying it's not concerning, but let's break it down. At the end of the day, what is the real driver of long-term rates? Our belief is that it is inflation. It's not technical selling. It's not anything else. It is inflation. We learned the lesson in COVID that we should have known by World War II. If you decide to put $4 trillion extra into the economy and you decide your central bank to basically finance that, guess what? You're going to get massive money supply growth. If you get that money directly to consumers, you're going to get inflation pretty quickly. If we continue to get higher deficits, as long as the Fed doesn't abrogate its 2% inflation target or purchase those treasuries, deficits on their own are not necessarily inflationary. Look at Europe, Japan, even China. The 10-year in China right now is 1.6%. The Chinese 10-year is lower on a nominal basis than the U.S. real yield. They've had a massive increase in debt there, and yet you don't have higher rates. So as long as the Fed sticks to its 2% target, doesn't finance the deficits, we're not overly concerned about inflation or rates moving significantly higher from that 2 to 2.5% real.
Just want to jump in with some commentary from the President of the United States and save everyone a trip to Google. A container for a bulk material such as grain, rock or trash. Hopper, OK? Many trade deals in the hopper. All good, great ones from the President of the United States on social media just moments ago.
There should be some fine print attached to this. These aren't trade deals. They are general terms, the memorandum of understanding, their letters of intent. You can see that this morning when the White House put out the general terms for the United States of America and the United Kingdom's negotiation, what they call a prosperity deal. So what you can get from this administration, they want to move ahead in terms of all of these talks, getting stuff on paper, coming to an agreement, but the actual trade deals will take years.
Can I just gauge expectations with you just quickly? What's your baseline for this weekend? What do you expect to hear when you return to work Monday morning?
The talks were constructive. That's what I'm expecting here.
Can you put some numbers on that?
I'm not expecting, we don't have a forecast on numbers. What I will say is 145, 80, 60, that's still pretty much a decoupling. And so the bid ask on those numbers, to me, is not the most relevant thing. I think starting the dialogue is the most important thing. I totally agree with what Annmarie said before, hit the nail on the head. We're going to get better trade deals with folks that we want to get better trade deals with. Just having the talks, constructive talks, that's what we're going to get out of this. I'm not expecting a lot of big news, personally.
Matt, appreciate your time, as always. Have a good weekend. Thank you, sir. Matt Diczok there of Maryland Bank of America Private Bank with an update on stories elsewhere with your Bloomberg brief. Here's Yahara. Hey, Yahara.
Hi, John. Details are emerging about the trade deal made between the U.S. and UK. According to a joint statement, the two countries, quote, intend to promptly negotiate significantly preferential treatment outcomes on pharmaceuticals and pharmaceutical ingredients. Meanwhile, Bloomberg reporting U.S. regulators are investigating what CrowdStrike senior leadership knew about a $32 million deal between the company and vendor Carasoft to supply cybersecurity software to the IRS. Investigators are examining internal CrowdStrike records and questioning former employees and are looking into other transactions made by the company. Shares are down nearly 2%. And Cardinal Robert Francis Provost has been elected the new leader of the Roman Catholic Church. The 69-year-old is the first pope born in the United States. He is also a citizen of Peru, where he spent much of his life as a missionary and archbishop. He chose the papal name Leo XIV. That's your Bloomberg Brief. John?
Wonderful scenes going into the weekend. Yahara, thank you. And you have a wonderful weekend too. Up next on the programme, we'll set you up for the week and the weekend ahead. In just a moment, we'll catch up with Tyler Kendall. She joins us ahead of trade talks between the US and China. Down on the week so far by 0.4% on the S&P 500. Looking to see if we can erase that at the opening bell. Looking for a third consecutive day of gains. On the S&P higher by a third of 1%. On the Nasdaq 100 up by 0.4. As we count you down to that opening bell, your calendar, your week ahead looks like this. At 9:15, the New York Fed President John Williams speaks on Bloomberg TV. Later on at 4 p.m, President Trump signing another batch of executive orders. Tomorrow, it begins the big one. US and China trade talks kicking off in Switzerland. Then looking ahead to next week, CPI data on Tuesday, plus President Trump heading to Riyadh for the first stop of his Middle East trip. On Thursday, PPI retail sales and another round of jobless claims, plus standout earnings report of the week, Walmart. Joining us now from the nation's capital, Bloomberg's Tyler Kendall. Tyler, just a day away from negotiations and the president signalling maybe we could drop tariffs to 80 and not below 60.
Yeah, hey, John. Well, it appears that it's going to be all up to Treasury Secretary Scott B., as President Trump calls him, as he and the USTR Jamieson Greer land in Geneva ahead of these talks. And Peter Navarro told you earlier this hour that whatever happens will be interesting for the markets. Investment really has been at the forefront of this administration's efforts when it comes to trying to calm investors and consumer concerns alike around their trade policies, and that they will come to the table in a meaningful way to de-escalate. But while President Trump has said that he will lower tariffs at some point because it amounts to a trade embargo, that 80% levy that he floated, it probably goes without saying that's a pretty prohibitive number. We're just going to have to wait and see how it all shakes out.
Looking forward to it. Tyler, get some rest. Tyler Kendall of Bloomberg down in Washington, D.C. will be up all weekend following these talks.
Well, exactly. Sunday basically becomes Monday when you're dealing with China and the United States and trade. The president is now saying 80% is potentially the level it can come down from. The market was looking for 50, 60%. Is this just strategic uncertainty, or should we be preparing for a new level of 80%? That's a big question I have.
We've asked a few times, what can you expect on Monday morning from investors? And they sit there and kind of shrug their shoulders. They don't know what to look for this weekend.
There seems to be a dampening in just how much stocks respond to any potential theoretical number. Will there be enough of a relief rally that can be sustained even if there is just better tones around the talks? Or is there something substantive that needs to come? And I think that is the ultimate test for how far this rally can go.
Look for talks to kick off over the weekend. Coming up on Monday, reacting to that, Russ Kostrick of BlackRock, the former Trump White House trade official Kate Kalukowicz, Torsten Slok of Apollo, and Mira Pandit of JP Morgan Asset Management. To those of you worldwide, have a wonderful weekend. To those of you stateside, have a very happy Mother's Day. From New York City, thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.
Welcome back to another Italian Open update for Bloomberg TV and radio from Tennis Channel. Iga Swiatek has lifted the trophy 3 out of the last 4 years in Rome, and the former world number one got off to a terrific start as she dropped just a single game in her opener against Elisabetta Cocciaretto. Swiatek didn't face a break point in the victory, which was her 11th consecutive straight sets win in the Eternal City.